Hi guys, is my voice audible to you now? Is it audible? Hello, mic check. Am I audible to you? Awesome. Okay. So we are live now, and I think everyone can hear me clearly. There's no issue. Please share the link in whichever group you are part of. Sorry for this inconvenience. I hope you understand me already. Awesome. Okay. Mic testing done. Just quickly share this link with everyone who is going to attend this session. Just quickly share these live class links in those WhatsApp groups. I'll just fix everything. Now it's loud and clear. Awesome. So I'll just hold this mic throughout the session, okay? Don't mind this. I'll manage it. I hope you can manage it with me as well. Anyways, let's get started now, okay? So welcome to the grand revision of SBR and FR for March 2024 attempt. And I know you guys must be worried about this paper. And apparently, I don't know if it has happened for good. Everything which happens for good. But your exam is now first in the row of the whole ACCA date sheet. So usually FR and SBR used to be, towards the end. But now it's like the first paper in our date sheet. So I hope that we are clearly going well on the, yep. Okay. So today we are going to talk about all these standards at a stretch. And I know it's a worrisome paper. It's a lengthy paper, whether it is FR or whether it's SBR, it's a worrisome paper. And I do admit that. But in this session, I will make it easy for you. But for that, first of all, I need you to calm down, okay? Because, see, right now, a lot of thoughts are going on in our head. This is pending, this is pending. I am to yet practice. I've not done pre-mock. I've not written mock. I've not done enough practice. Will I pass? All these thoughts which are going on in the mind, just stop them for now. The only focus that you should have is on this video, on this live that you're attending. Because this can be a game changer. This can be something, okay? This can be something which can lead to success, which can be the reason for your success. Okay. And it has happened to many students in the past. There have been many students who message me, ma'am, we just watch your grand revision, or we just, previously it used to be not a free session. This time it's a free session. So many students have passed just with these sessions. And whatever I'm going to teach you, I don't need any book in front of you. If you have my notes with you, then you can use them. The ones who were registered with me, they must be having. If others have it, they can share it with themselves. Otherwise, no need of any book, any pen, paper, nothing. Just the video and me and your mind. So let's get started. Okay, I'm going to go standard by standard and I will be discussing many standards with you. Almost every standard will be discussed. I will tell you the FR aspect of it, SBR aspect of it. So SBR students, whatever is tested in FR is obviously there in SBR. But the FR students, you might have to listen something which is complex. So I'll tell you that this pertains to SBR. So for that point in time, you can just shut your ears. Otherwise, the whole session is for everyone. Yes, it's for everyone. So let's get started. and I hope I'm audible to all. So let's start with our revision, everyone. So we have 300 people in the house. Come on. No energy deficiency in this session. I'm not energy deficient. I don't want you to be energy deficient as well. So starting off, I want to discuss with one thing, which is the basis of all the IFRSs, basis of all the SBR or FR topics which we have, that is conceptual framework. So conceptual framework is just like, moral science lecture. It will tell you that this is how things should be. This is how the IFRS should be developed, or this is the objective. What is the objective? The objective is that my financial statement should have relevance. These are the two words. Come on, SBR students, you get such gray areas in your paper. So you know that these are the two gems that you should have in your pocket whenever you're framing an answer. Yes. So relevance and faithful representation. What is relevance? Whenever I write anything which is material, whenever I disclose everything in my financial statements which is material. What is faithful representation? Come on. What is faithful representation? What is faithful representation? Complete, neutral, free from error. These are the qualities of a good financial statement. They will be complete, 100% coverage. Every transaction, every account balance is being recorded. That is what complete is. What is neutral? It is unbiased. We are being objective. So in any situation, SBR students, so in any situation where you find the accountant being biased, let's suppose he says, I just want to consider the needs of the directors, or I just want to consider the needs of the shareholders. So he's being biased. You are preparing financial statements for a whole group of stakeholders, which includes shareholders, which includes employees, and not just the shareholders or the employees. So how can you be biased? So if you are biased, then that is against objectivity. That is not neutrality. So in the question number 2 of your SBR ethics, you can use this terminology and you can make your answer out of it, that here the accountant is breaching his objectivity. He is not acting neutral. And if he is not acting neutral, then what? If he's not acting neutral, that's against the ethics. Yes, that's against the ethics. So it's also against the ethics and the conceptual framework. So C and F, free from error. Everyone knows what is free from error. Where there is no mistake, that is free from error. That's my faithful representation. Also in faithful representation, I have substance over form. Yes. So in SBR, you get marks for writing basic things also. In your case study, if you write the conceptual framework, what does it say about qualities of financial statement, you get marks. Whenever I'll be doing a standard, I will try to relate it with conceptual framework because you get such questions. What is substance over form? Whenever I consider the economic condition, or whenever I consider the economic substance over its legal form. Example, sale and lease back. In IFRS 16, sale and lease back, you guys refer to IFRS 15 to consider whether it's a sale or not. However, in reality, it is a sale. Still, you refer to IFRS 15 to see whether it is a sale or not. So that is where, you are saying that economic substance might be different as per the standard, but legally it is a sale. Still, we will consider whether transfer is a sale or not as per IFRS 15. So this is something, yes, this is something which we consider in conceptual framework, faithful representation. Then you have measurement basis. What is there in conceptual framework? Measurement basis. What are the two measurement bases? Current cost and historical cost. So when I keep my asset at current cost, what all is included? Fair value is included, replacement cost is included. Yes, value in use is also a type of current cost. What is historical cost? When you keep it at carrying amount, that is historical cost. When you don't take it to its current value, when you don't take it to its fair value, that is current historical cost. So how do you decide which basis should I choose out of these two? How do I decide as an accountant? So I have some factors in my mind. What are these factors? Factor number one, I need to consider the individual characteristic. I need to consider the individual characteristic of that particular asset or liability. Is it something which is unique? If it is unique, how will you find its value? Of course, you need to record it at cost. Then you don't have its fair value, no? Then how will you have the active market? How will you have anyone buying and selling unique asset? Then you consider how it contributes to future cash flow. What is future cash flow? Do you want it for long term? Do you want it for short term, medium term? Based on that, you decide, okay, if I want it for short term, I will be selling it in few days, few months. So let's keep it at fair value only because we are going to say goodbye to it very soon. So that's why we keep it at fair value. And have you seen this thing applicable? Have you seen this thing applicable in your standard? Do you know any standard where this concept is applied? Do you know any standard where this concept is applied? IFRS 9, where I say that if the asset is to be kept for short term, keep it at fair value through P&L. But if the asset is to be kept for medium term, keep it under fair value through OCI, but still fair value. But if you want to keep it for a longer term, that is still maturity, keep it under amortized cost. So can you see the relation between conceptual framework and IFRS 9? SBR students, you need to understand this. There might be a 6 or a 5 marker like this in your paper. Yes. So this is future cash flow. We depend on future cash flow. Thirdly, we also consider the cost benefit. So what will be the benefit of taking it to its current value versus what is its cost? If it is of $10 asset, why would you take it to its fair value? You'll go to an expert, you'll get it fair valued. What's the need? There's no need, right? So that is one thing about measurement basis. And then definitions. Very important. What is the definitions? Even in FR, you can find an MCQ on this. What is an asset? Come on, quickly. Keywords of asset. Type it in the chat box. Keywords of asset. Economic resource. It's an economic resource, okay, which you control due to past event. Yes? This is what an asset is. Previously, we used to talk about the probability concept, but in 2018, that probability concept was waived off. Yes, but now we have basic definition of an asset, anything which will lead to future inflow of economic resources, which we control due to a past event. So these are the three keywords in the definition of asset. So every standard, for example, why don't you capitalize training cost? Why do you not capitalize training cost? Only one reason is there, because you don't control it. How many students are there in this? Around 350, right? So can I control how much every one of them is getting? How much I'm training you, right? This is training, but I can't control. Maybe one student is getting way too much, another student is not getting way too much. So that is something we need to understand, that control is when you can direct the use of that asset. Yes, that is when you control it. When you have the risk and rewards of that asset, that is when you control it. So past event, we all know. Then what is the definition of a liability? Anything which leads to outflow of economic resources. This term resource was added. It's not benefit, it's resource. So outflow of economic resources, once again, due to a past event. Now, this can be a contractual liability. This can be a legal obligation. This can be a constructive obligation, anything. Anything which is going to lead to future outflow of economic resources due to a past event is a liability. Then what is the definition of income? What is the definition of expense? Income is something which increases my equity. Income increases your capital, profit is added to capital, profit is added to retained earnings. So it increases your equity. Then it is something which decreases my, if my liability decreases, that's also my income. And if my asset, everything happy is an income. So should my asset decrease or increase? Yes. Should my asset increase or decrease? Income is when my asset will increase. So asset debit, income credit. Then expense when equity reduces. Similarly, when liability increases and when asset decreases. This is the definition of expense. Now you might be wondering why ma'am is teaching us this few days before the exam. SBR students, hello. So you have this in your marquee company question. If you have tried Kaplan kit, they've asked you, they've related share-based payment, IFRS 2, with the definition of expense. FR students, close your ears. So in the definition of expense, it's written that the equity decreases. But in IFRS 2, the definition says, or the entry for share-based payment is expense debit, equity credit. For equity settled share-based payment, this is my journal entry. So if my equity is getting increased, then why am I recording an expense? There's a conflict. Now, who all can identify this conflict? People who know IFRS 2, people who know conceptual framework, people who know the definition of expense. So that is why these basic things are also very important. And how we have justified it in Margi company question, we've said that, okay, this is as per the standard. And whenever there's a conflict between the standard and the conceptual framework, standard always wins. So the debate ends here. Also, we can assume that our employees are our resources, they are our assets. As in when we are, using our asset, so our asset is decreasing. That is the reason we treat it as an expenditure. So this is what as the, they have given this as a conclusion, right? So this is what we have for conceptual framework. Let's move on and let's discuss now the non-current asset. Whenever I will tell you that please note it down, then you are supposed to note that stuff down. Otherwise not. So if you are weak in these three standards just for few hours before your exam, especially the FR students, if you want, you can make this table along with me. So you all know that IS 16 is property, plant and equipment. So property, plant and equipment is when I use my property in the process of manufacturing. Yes. Then I use it maybe for owner occupation. So it's owner occupied. Maybe I use it for administration. Sometimes I give it on rent also to others. So maybe the owner is living in the ground floor, the above floors are given on rent. That is also PP. Then IS 38, what are the criteria? Everyone should pay very minute attention to the definition of intangible asset. You might be asked to, as it is, write it. It's the keyword of recognition of intangible asset. So I will recognize my intangible asset. Number one, when it is identifiable. Come on in the chat box. What do I mean by identifiable? Can be sold separately. Can be sold separately. Arises out of a legal or a contractual right. Yes. So this is what I mean by identifiable. And if that asset can be sold separately or is arising out of a legal or a contractual right, and it has no physical substance, yes, and its reliable measure is available, then only I record that particular asset as intangible asset. So these are the criteria of recognition of intangible asset. Then what is the criteria of investment property? Any property which is idle, any property which is there for capital appreciation. Any property which you keep to give it on rent to others, that is investment property. So this is the definition of these three standards. And in any situation, if you find, for example, if there's a construction business and they have some properties, so you need to figure it out. Do they have this property to sell it to the customers, or are they going to use this property for their own use, for their own business? Yes. So how you're going to bifurcate between it? How are you going to bifurcate between it? You're going to say that the property which is kept for the customers is my inventory under IAS 2, and the property which is to be used by me as my offices is my property, plant and equipment under IAS 16. And the property which I have myself purchased for capital appreciation, or I'm giving on rent to people, then that is my investment property under IAS 40. So this is what you do in your non-current assets. Now, if I talk about the accounting treatment, very important. Yes, if we talk about the accounting treatment, what are we going to do? Let's write it down. IAS 16, IAS 38, make this table along with me, and IAS 40, investment property. So IAS 16 initial accounting treatment is, please record it at purchase price plus directly attributable cost plus the dismantling cost taken at its present value. Whenever you calculate present value, the sibling of present value is unwinding of interest. So don't forget, whether it's groups consideration, wherever you calculate present value, don't forget to unwind the interest thereafter at the reporting date. And since you're saying that I will be making the payment of this dismantling cost at a future date, so a provision is also required. So initially your entry is asset debit, dismantling provision credit at present value. Subsequently, I will increase my provision by the amount of unwinding of interest. Then I add borrowing cost to this, IS 23. Then any irrecoverable taxes, they are also added. Yes, irrecoverable taxes are also added. That's what you do in the initial treatment of IS 16, IS 38, and IS 40. It's exactly same, right? So that saves our time. What is the subsequent treatment? For IS 16, you have two methods, cost model and revaluation model. For IS 38 also, this is same cost model and revaluation model. For investment property, we have cost model and fair value model. Yes. So this is what I have as my choices in various standards. So what do I exactly account for it as in cost model? Cost model means I keep it at carrying amount, which is cost minus depreciation minus impairment. Impairment comes from IS 36. What is revaluation model? Come on, everyone. Let's see what's the difference between revaluation model and fair value model of investment property. So revaluation model, quickly in the chat box, revaluation gain. If there's a revaluation gain, what's the journal entry? First, I need to debit all the related accumulated depreciation of this asset. Yes. Then I need to increase my asset. So asset debit by the balancing figure. Gain goes via revaluation surplus, which is OCI item. Goes via the comprehensive income. How do you value revaluation loss? First, you take out the revaluation loss from the revaluation surplus. So the standard says, if related to that asset, if there is any surplus, if related to that particular property, plant and equipment, there is any surplus which exists, then only I will debit revaluation surplus. And of course, my asset will get reduced. So asset credit, yes. And the balancing figure goes to P&L. So loss on revaluation goes via P&L, gain on revaluation goes via OCI. This is something which we can roughly conclude out of this, right? Yes, we all clear on this? Okay. Now, what do we do in fair value model? What do we do in fair value model? In fair value model, we first of all take whether it's a gain or whether it's a loss. It goes via statement of profit and loss. Then you do not have any depreciation charge on this particular asset, that is your investment property. So no depreciation, gain or loss goes via P&L, simple. So you take it to its fair value at each reporting date. That's the accounting treatment of investment property. Correct? Let's move on. So we have dealt with all these three standards. Now just specific to intangible asset, because intangibles are widely tested in SBR. If I talk about intangible asset, which model is more, you can say, comfortable to any accountant? Cost model. Why? Because fair value is rarely available for any brand, rarely available for any intangible asset. And you also need to understand that we do not record internally generated brands. We do not record internally generated brands, goodwill, blah, blah. But we do record internally generated brands, same brand, but when you're doing consolidation, only then. So if you have purchased the subsidiary and that subsidiary has a brand which is internally generated, you will record it. But in the individual accounts, you will not record it. And then the intangible assets are of further two types: definite life intangible asset and indefinite life intangible asset. Definite life intangible assets are amortized, yes, over the life of the asset. Indefinite ones, on them we conduct annual impairment review. Right? So this is what we have. This is what we have for our, yes. Are we guys clear on it? Quick yes in the chat box. Are we guys clear? Yes. Awesome. Let's move on. Let's move on to impairment. IS 36 impairment. So just one thing out of impairment, we only conduct impairment whenever there are indicators of impairment. Ma'am, what are the indicators of impairment? It can be external indicator, it can be internal indicator. External indicator is which is not in your control. Internal indicator is any indicator like your KPI has reduced, your key personnel has left, or internally there was some shift in the, or there was a restructuring in the company. So that's also an indicator of impairment, which has led to decrease in the value of the asset. So that is what impairment is. And what is the impairment review? When I compare the carrying amount, of the asset with the recoverable amount of the asset. Now, what in the world is this recoverable amount? Recoverable amount is higher of two amounts: value in use and fair value less cost to sell. What is value in use? Present value of future cash flows. Present value of future cash flows is my value in use. And this is something which comes from IFRS 13 level 3, because you estimated. How do you know what would be your cash flow? That's a projection. So that is something which is risky, right? So value in use, you should use constant growth rate when you assume how much money you're going to make, or you have to use zero or reducing growth rate. So this is what you should know from impairment. And impairments journal entry is exactly same as revaluation downwards. Yes. But then there is a concept that whenever you impair an asset, we need to keep on looking that if there's any reversal, we need to keep on looking if there was any reversal of the impairment that we have conducted. How will we look for it? Why did you conduct impairment? Because there were bad factors, there were sad factors. So maybe there's happiness around. Maybe things have improved. Maybe you've come out of the recession. Maybe the inflation has reduced. So there are some good factors also. It's not always bad. Be positive. You have good factors also. So at each reporting date, you have to keep on looking for the good indicators as well, because they will suggest that whether there was any reversal of impairment or not. And if you want to reverse the impairment, what is the standard saying? Listen to it calmly. What does the standard says? They say you can reverse, we can reverse the impairment loss. Yes, we can reverse the impairment loss up to the extent, of what would have been my impairment or what would have been my carrying amount if, if you have done a software thing like programming, you put these conditions. So reverse the impairment loss up to the extent what would have been the carrying amount if there was no impairment at all. There was no impairment at all. Because guys, whenever you impair an asset, its depreciation changes because it's a revaluation, right? After revaluation, you're supposed to calculate depreciation on the revalued amount divided by the remaining life of the asset. So after impairment, my depreciation changed. So they're saying, what would have been your carrying amount if there was no impairment at all? You can only reverse the impairment up to that extent. Just know this theoretically, okay? Just it's least probable they'll test you numerically on this. So I hope we all know this. Yes? Okay. Awesome. Let's move on. So we are done with IS 36. Next, very important standard IS 23, borrowing cost. Borrowing cost, only one keyword is there. What's that keyword? Qualifying asset. Yes, qualifying asset. So what is a qualifying asset? Any asset which takes substantial period of time for its construction. So it can be a building which you're constructing. It can be a development project. With development, I remember research and development, I'll talk about it. So qualifying asset is anything which takes substantial period of time for its construction. So if you have taken any loan on the development or construction of such an asset, so for the period of construction, you are supposed to capitalize, the borrowing cost. Yes, you're supposed to capitalize the borrowing cost. So that is something which is very important. But at what rate? At the capitalization rate. How do you calculate the capitalization rate in case of general borrowings? You use weighted average method. So you are like, okay, the capitalization rate would be if I've taken two loans, one of 6 million at 6%, another of 4 million at 4%. So I will say my capitalization rate is 6 million into 6% plus 4 million into 4% divided by total loan amount of 10 million. So this is how you calculate your capitalization rate, and thereafter you capitalize the borrowing cost into the cost of the asset, right? So this is what I have in my borrowing cost. Lastly, see, there are many standards, but I'll discuss the important ones. I'll discuss IFRS 5 from non-current assets. So IFRS 5 says, it talks about non-current assets. So it's first of all on non-current assets, which are either held for sale. So either you've sold them already or you're holding them for sale. That means you'll sell it in future. And discontinued operation. So many questions are asked. Is this a discontinued operation? So in the questions of SBR and even in FR, they ask you, they give you a subsidiary which the company is planning on to sell, and they ask you if it is a discontinued operation or not. Yes. So what is it? Discontinued operation. Discontinued operation is any major line of business, which is a separate major line because of its operation or because of its geography. So either it is because of its operation or because it's located in a good location, so geography, and or any subsidiary which you initially purchased. So when you bought this subsidiary, your view was with the view of reselling. Yes, with a view of reselling. So if this condition is met, then only you can classify it as a discontinued operation. And together with it, of course, the held for sale criteria should be met as well. You must have kept it for held for sale. What is held for sale? What is the criteria? All students of mine would know it. Anyone who's attended my sessions ever. Caption. What is caption? Come on, quick. What is caption? What is caption? Yes. What is caption? Come on. C stands for. Barisa, caption. C stands for commitment to sell. So in the case study, you are supposed to see, are they committed to sell? How will you know they're committed to sell? They won't give you a paper of marriage that, yes, we are committed to do this thing. Of course, that's not going to happen. So there will be a commitment to sell, maybe in board minutes, maybe in the way they talk, maybe some announcement that they've made. So there must be a commitment to sell. There must be an active plan. If I say that, I want to sell this thing, the value of that particular asset in the market, actual value, original value is 1 million, and I have it since 3 years, so it's a second hand product. So of course I should sell it at a lower point. No, you can't sell something which is the new product is of 1 million, you can't sell it for 1.2 million. So that is something, if you keep a reasonable price, that means you have an active plan. Then P stands for that you will sell it in the present condition. So if you say that I will modify this car first and then I will sell it, then you're not selling it in present condition. You need to sell it in the present condition without any modification, without any renovation, without any repair, right? And then sale is probable. Sale is probable. That means now they again talk about probability. However, in conceptual framework, there is no probability of conflict. Mention it in your standards, mention it in your case study answers. There's a conflict in IFRS 5 and conceptual framework. What are you doing, ISP? You need to revise your standard. IFRS 5 needs a revision. So sale is probable. Then within 1 year, what is 1 year? 12 months. So sale must happen within 1 year. But what if, ma'am, the sale does not happen within 1 year? What to do? You need to determine. Be flexible. IFRSs are principle based, they are not rule based. So be flexible. You get into that case study and, use your judgment, use your ACCA knowledge, training, and experience, and figure it out that did this happen, which was because of something which was out of your control? So, was this out of your control or was it in your control? That means you did it purposely, that you delayed the sale. Was it because of you or was it because of something which was not in my hands? So if it was because of something which was out of my control, then we are flexible and we are like, okay, if still you think sale will happen in the next 12 months, then keep it under IFRS 5, no problem. But if something was change of your intention, then you ditched the standard. You said you will make the sale within 1 year, but you didn't. Now that is bad. Now standard is offended. So he will say, get out of me. Get out of the standard. IFRS 5 says, bye. You're not allowed. So you will be moving out of the IFRS 5 and you'll come back to whichever standard it was, whether IS 16, IS 38 or IAS 40, right? So this is 1 year. Then N is useless. No change to plan. This is delta, which means change. So there must be no change to plan. Once you've made a plan of selling it within 1 year, it should be within 1 year. This is what I mean by capsule. Right? Are we all clear on this? Yes. Is everyone clear on this? Come on, quick yes or no. Awesome. Okay, let's move on. IFRS 5 accounting treatment. Keep the asset at lower of cost and NRV. Yes, because you're going to sell it to keep it at lower of cost in NRV, take the loss via statement of profit and loss. In discontinued operation, you do the same thing. Only one thing is extra, that in your statement of profit and loss, as part of your one line, you put profit after tax from discontinued operation as one line item in your P&L. That's it. So in a question of SBR, if you figure out any subsidiary which was planned to be sold but was not actually sold yet, you need to see whether caption is met, and then you need to see whether it's a major line of business or not. If it is a major line of business, you need to apply maybe the rules of IFRS 8 operating segment. That's your choice. And then you will conclude whether it is a subsidiary which was discontinued operation. Yes. Okay. Let's go on. IFRS, not 9. I don't know why 9 keeps on coming. Revenue. IFRS 15, revenue from contracts with customers. First question comes to our mind, why was this standard needed? No, you were already having IS 8, IS 18. Why did you need IFRS 15? Because there were some criticisms of IS 18. SBR students, pay attention. Why did you need IFRS 15? Because the previous standard was not good enough. So usually whatever you find not good enough, you replace that. So you replaced IS 18 with IFRS 15, where you said now we have better standard because now this will prevent frauds. Why? Because in IS 18, they just talked about at a point in time sale. They didn't talk about complex contracts. And they didn't talk about complex situations. In fact, the people who are preparing for SBR UK GAP, they still talk about IS 18. They still have some rules like IS 18. So they don't talk about complex situations. So what is IFRS 15 all about? There are 5 steps of revenue recognition. First, identify the contract. What is a contract? Where both the parties have rights and obligations. Okay, I'm not going to explain that. Second is, you are supposed to see the performance obligations, separate performance obligations within a contract. So those separate performance obligations are distinct. They are called as distinct if delivery of one, yes, if delivery of one is independent from the delivery of the second product or service. So in that case, these are separate performance obligation, both from the perspective of customer and from the perspective of the supplier. Yes, so that is distinct. You have a question ZTech on this, SBR students? I think the question name is ZTech only. So there they talked about distinct product or service within the contract. So you're supposed to apply this concept whether delivery of one is independent from the delivery of second. Then once you've identified separate performance obligations within one contract, then you're supposed to determine the transaction price. Now that's interesting. Within the transaction price, we have various situations. Situation number 1. It's not very normal, no, that I will have a contract and I will say this contract is of $100 million. No, they don't make our life easier. They always make it tough. So what are the points there? Yes, what are the points? Let's see. Point number 1. We have variable consideration. Variable consideration. How do you record a variable consideration? They say record it up to the extent you think that you will not have to reverse it once the uncertainty is resolved. So that means record it if it is probable that you'll receive it. So record it only if it is probable that you will receive it. You can even calculate its expected value. Yes, expected value is the amount into the probability, that is expected value. So I can calculate the expected value and record my variable consideration. Then second, significant financing component. So if someone says, I will make the payment, but I will be making this payment after 2 years. If you say, you need to pay me interest, no? So you will pay me 1 million after 2 years, but what is today's value of that 1 million? So you'll calculate today's value and then record it. So your entry will be receivable debit, revenue credit by the amount of present value. But later on, since you calculated present value, one thing comes along with it, unwinding of interest. So later on this receivable, you will unwind the interest as receivable debit, finance income credit. So in any situation where you are stuck, guys, where you're getting an income which is like out of nowhere, and you feel that this is not revenue, we don't know what it is. We've raised finance through this. You can treat it as finance income. Yes, you can treat this as finance income. So that is the second point. Then what's the third point? Yes, cash payable to customer. So what do you treat this as? Why will you pay cash to customer? Imagine you enroll with me at TG Professionals and I say I'll pay you some money. Imagine. Now stop imagining. Okay. So if you have cash payable to customer, you treat it as a discount. So see, if you are also business, I'm also business, and I make a sale to you, but I also purchase stuff from you. So in that case, I cancel out the accounts. No, you are my payable also, and you are my receivable also. So I will have your name as my ledger, and I'll cancel it out. That is cash payable to customer. But what happens in case of when last situation where you get non-cash consideration? What is non-cash consideration? Barter system. So I gave you the example, my students, I gave you the example of you giving editing services to me and I am giving you tutoring services. By the way, if anyone is a good editor, please WhatsApp me. Okay. So non-cash consideration, what it is? We say we calculate the fair value of what service we've received. So when I will sell my SBR lecture to you, I will ask you, how much do you charge usually for your editing services? Then you will say, ma'am, I don't know. I'm doing it for the first time. So then, first I will ask you, so fair value of service that I receive. First, I'll assume that to be my revenue. But if it won't be determinable, if I think no, you are not having a reliable measure of it, then I'll say, okay, no problem. I know the standalone selling price of my SBR lectures, so I will treat that as my revenue. You understanding? First, you take the fair value of the service received. If that is not available, then you take the fair value of the good or service provided. So that is the rule for IFRS 15. Step number 3, determination of transaction price. Step number 4, allocate. Yes, allocate the transaction price to various performance obligations. How do you allocate? You allocate on the basis of standalone selling price. Yes. So you see, on pro rata basis, I'm not going to explain this to you. You are now grown ups. You've done SBR for 3 months. I hope you know what is pro rata basis. You know, FR students also know that if the transaction price was of $1,000 and there were few performance obligations for $10, $5, $70, $50. So of course you're getting a discount because you're getting a clubbed performance obligation. Single contract is there for $100. So you will prorate it for every based upon their standalone selling price. Okay. Then last and the most important step, recognition of revenue. Now this is very important. Let's calm down. I'm telling this to myself only. Recognition of revenue. I can recognize revenue in two ways. At a point in time, over the period of time. When do I recognize my revenue? At a point in time, whenever it is not over the period of time. So this is a very simple, cute concept. It simply says if it is not OTP, then you can keep it at ATP. He is not high maintenance. This is high maintenance. OTP. What would OTP say? It says if any of these conditions are met, then only you can record the revenue over the period of time. What are these conditions? Yes. What are these conditions? First, if the customer simultaneously receives and consumes the benefit. Ma'am, example, you, what are you doing right now? Okay, I'm not asking exactly what you're doing. I'm saying you're attending this live session. So in this case, you are receiving and consuming the benefit. Can after the live session, I say, please give me back the knowledge that I've given you? No, because you've consumed it. Yes. So you received it, you consumed it. So I will record my revenue over the period of time. Imagine this session going for 3 months. Then, of course, I'll record the revenue over the period of 3 months. Yes. Then, second is if you are creating or enhancing an asset, creating or enhancing an asset which is controlled, by the customer. So imagine there is a piece of land of the customer and I'm a construction business. I am, building the property over it. One fine day, customer says, I had a fight at home today. You are removed from the contract. Don't come from tomorrow. Imagine you've spent lakhs, dollars, millions on that. And now the next day, the customer says, please don't come. So in that situation, you refer to the contract and you see whether you have enforceable right to payment. See, if you do not have enforceable right to payment, then I'm sorry. I don't want to use the Hindi language here, but yeah, it was really bad. You are not going to receive anything out of it because now it's gone. There's no right to payment. Customer said, don't come, you won't come now. You can't be Bob the builder and pick up that building with you and run away from there and say, no, or you can't run a tractor over it or a bulldozer over it. Not possible. So that is why we refer to the contract and assume whether there's an enforceable right to payment or not. If there is, that means I will get my money as per my progress. If I've built one floor, I'll get money for that. So I will record my revenue also based on my progress. That means over the period of time, right? So let's go on. Third, what it is, if you are doing customization, that means you're creating or enhancing an asset which has no alternate use to you. So that means you all have made those gifts for your brothers, sisters, or maybe for your friends, customized. So if imagine you got your sister a pillow with a face of her on that, that cushion which we get, that fancy stuff. Would any customer like to buy it? No. You got it for your mom, a mug of your mom's face on it. Anybody would like to buy it? No. So it was customized for you. So if you get into such contracts which are customized, we assume an enforceable right to payment. And in that case, also we record the revenue over the period of time. Right? So that is, yes. So that is what we have in our three conditions. Customer simultaneously receives and consumes the benefit. We create or enhance an asset which is controlled by the customer, and we have enforceable right to payment. And lastly, it's a customized stuff. That's it. So these three conditions, learn, retain to memory. Remember the examples. I gave you funny examples for a reason because I need you to retain them. Even if you forget the conditions, you won't forget the example. Let's move on. The 5 steps, but it's not over yet. We talk about contract asset. Okay, let's talk about 4 steps which are there to record the revenue over the period of time. First step is, you need to see whether it's a profitable contract or not. You need to see its overall profitability. So what do? You take the transaction price, you deduct the contract cost from it, whether it's estimated cost or actual cost. You get whether it's an overall profitable contract or loss-making contract. If it is loss-making contract, we call it as onerous contract. For onerous contracts under IS 37, now IS 37 kicks in. It's like, me too, me too, me too. Onerous contract says, I need a provision on onerous contracts. That means if it's a loss-making contract, why are you doing it? If you think it's a loss-making stuff, why are you doing this? Yes? So if I say, doing this whole thing for you, it's loss-making to me, then you will ask me, ma'am, why are you doing this? So same the standard does. It says if you are doing it, maybe there is some restriction on you. There is some legal liability on you. So you make your provision at lower of two amounts. the cost of terminating that contract, yes, and the cost of continuing that contract. Obviously, if I think there's a contract which is loss making to me, you will always say, ma'am, get out of that contract. But then I'll say, no, there are legal fines and penalties which I will pay. So then you will say, okay, how much is the fine? We'll consider that. Then we'll consider if we continue with this contract, how much loss we will make. So we will choose the lower out of the two. How realistic, how commercially acumen. So that is why we record the provision on onerous contract on the lower of these two amounts. Then as soon as you identify it's a loss-making contract, record the full loss as per this criteria. Second, if you think it's a profitable contract, you are supposed to, measure the progress. How much progress have you made in that contract? You have two methods: input method, output method. Output method is based upon how much work has been done. If you were asked to do 5 chapters, out of that you've done 2 chapters, which is the case here, I know. So that means the work done is less. So output is less. Input is, if I talk about the fees that you've paid into various learning providers, which you guys pay a lot. So if your input that you've done, okay, have you taken classes? How many classes have you taken? How many tutors you're registered with? So if we consider that, that is input, right? So that is progress. Then now you're supposed to estimate the revenue to be recorded in the statement of profit and loss. So if the transaction price was 1 million and the progress percentage was 10%, so you will say only 10% of the revenue would be recorded. Last step is contract asset or contract liability. What is this? I compare the revenue that I've recorded. Yes, I compare the revenue that I have recorded with the receivable, the amount received or billed to the customer. So the revenue, the work you've done till date is of worth 1 million. The money that you've asked from the customer is 1.2 million. So imagine you just did work worth of 1 million and you're already receiving, or you are asking the customer to pay 1.2. So 0.2 is your contract liability. That's income received in advance in your language. In IFRS language, it's contract liability. So it's a liability that I have to perform for the customer. You know, you are not an ethical person that you'll take the money and run. So you are going to be there. So it's your obligation to do the stuff for the customer. So that's why it's a contract liability. Then opposite situation is there when a contract asset is created, where you compare revenue, where you compare the revenue with the received amount. So if the revenue was of 1.2 million, but you've just billed the customer 1 million. So you are a very sweet person, first of all. Kudos. So you've just asked 1 million and you've done work worth of 1.2. You say it's my contract asset. Yes, that's a contract asset. So this is whole process of revenue recognition as per IFRS 15. Are we guys clear on this? Yes. Are we guys clear on this? Come on. Yes, guys, the recording will be available after the live ends. Awesome. We are all alive, enjoying the session. Take a deep breath. It's okay. I'm saying this to myself only. Anyways, let's talk about IFRS 15, very new concept which was introduced, that was of sale and repurchase. You know, in this IFRS world, they keep on doing weird things. Even I don't understand why they get into such weird situations. But then they first get into those weird situations, then they find a solution to it. Then they find a solution of recording it in the books of accounts. So that's what they do. Yes. So what it is? Sale and repurchase. Sale and repurchase says that if you have sold something to the customer and then you give in an option that you can, you can take it. You say that I might take it back from you. Is that a sale? If the seller has an option to call for the asset back, call for the product or service back. So let's suppose I sold you some goods and I can call you and ask you, please give it back. Is it a sale? No, it's not a sale. Then, if the seller has an obligation to take it back, if the seller has an obligation to take it back, that means there's a forward. In future, that means after 5 years, I've sold something to you. After 5 years, I'll take it back from you. Example, when you keep any asset on as a secured loan, like you keep it as your asset is kept as security and in return you get loan. That is a situation where you have to take that security back from the bank. So practically, you've sold your asset to the bank, you received money, you gave your asset, the control maybe was given because the papers were given. And now, after some time, you have to take it back. That is forward. So, call is not a sale, forward is not a sale. Then what it is? If the repurchase price is greater than the original selling price, then we say it's a loan. If the repurchase price is lesser than the selling price, we say it's a lease. This is the accounting treatment. Okay. Next, put option. What is put option? This is important. Just know this much. I hope this is a very, I could have explained this with examples, but we don't have time. We should have done it before. It's just a revision. If repurchase price is greater, then we say it's a loan. If repurchase price is lesser, we say it's a lease. But what is this put option? It's very important. Put option is with the option is given to the buyer. Now you sold something and the buyer has the option that he can keep it in front of you and say, take it away. Now there are two situations. Buyer came to you crying, please take your house back. I don't want your house. It's haunted. And you are like, you will see the contract. Do you have an obligation to take that house back? Do you have an obligation to take that house back? Or you do not have an obligation to take it back? If you have an obligation to take it back, then again it is not a sale. But if you do not have an obligation to take it back, then it is a sale. So only one situation when it is a sale is when the buyer has the option and you don't have an obligation to take it back. So in that case, it is a sale. Otherwise, it is not a sale. Same rules will apply. If repurchase price is greater than the selling price, it's a loan. If the repurchase price is lesser than the original selling price, then it's a lease. Yes, this is for all FR and SBR students both. It's there in FR also. Yep. So come on, guys, you're not liking the video. I've just liked it once. No like on the video. So we are done with our sale and repurchase as well. Now, let's talk about contract modification for SBR students only. FR students, ears close. Contract modification. If you modify the contract, that means you say, I was giving you XYZ products and services. Now I'll give you ABC products and services, or I'll give you more products and services. How to determine this? Either it will be part of the same contract or it will be a separate contract. Yes. Or you will terminate the existing one and create new. So let's understand. If the new additional goods and services which are provided, if you provide additional goods and services to the customer, existing customer, and they are distinct, then either you'll go for this or you'll go for this. So imagine you were enrolled with me for SBR. Now you say, ma'am, we also want to enroll for AAA at TG Profs. So that is distinct. Course of SBR and course of AAA are two separate courses. They are distinct. So I will say that either I will terminate the existing contract and create new, or I will treat it as a separate contract. It won't be a part of the same contract. These are two different courses that are being sold to you. When it is this and when it is this, if you have got a discount, just in very basic spirit of the standard, spirit of law matters, not exact law, spirit. Spirit says if you get a discount on the additional good that you're getting after modification, in your case, it's AAA paper. So if you're getting a discount because you guys negotiate a lot, you're like, ma'am, I'm already taking SBR with you. Can you give discount for AAA? That's what you do. That's how we negotiate. Everyone does it. Nothing bad in that. So in that case, you got a discount. What I'll do, I'll terminate the previous contract and I'll create a new with the new selling price, with the new transaction price, combined price. When you do not get a discount, then for me as a business, I can separately identify you that this person was there for SBR also, AAA also. He purchased SBR at full price, AAA at full price. There's no discount given. So in that case, SBR is a separate contract, AAA is a separate contract. But if you get a discount, terminate the existing, create a new, and if they are non-distinct, then it's part of the same contract. Right? Okay. That's it. So this is contract modification, and that ends our IFRS 15 revenue. Just give me a quick yes or no. Are you clear about this? Yes. Are you all clear? Okay. Big yes. Okay. Let's start with IFRS 16 leases. Because next standard is gonna be financial instruments, which is favorite standard for all of us. We love financial instruments. Let's manifest it does not come up anyways. So IFRS 16 leases, we talk about when we have given anything on rent or we have taken anything on rent. That's how world is working these days. Everyone is staying on rent. That's more cost effective and it saves your capital. You can invest it. Just an advice. So IFRS 16, we talk about two types of accounting, lessee accounting and lesser accounting. So this lessee accounting is what I'll discuss first. In this case, the person who's taking the apartment on rent will create a right of use asset and he will create a lease liability. What all are the components of lease liability? Present value of lease payments. What are the components of lease payments? What are the components of lease payments? Fixed rent that I pay, variable rent that I pay, any termination penalty if it is probable that I'm going to terminate the contract, so termination penalty, any option to extend the lease, if it is probable that you will extend the lease, include the cost in that as well, right? That is all part of lease liability. That is all part of the lease liability payments. So when you discount it to present value, you get lease liability. Which factor should I use? Which discounting factor should I use? I should use the interest rate. I should use the interest rate implicit in the lease. So any lease contract will have some interest rate already embedded within this implicit. If it is not there, okay, if it is not there, then what you will do? Then you will take incremental borrowing rate. What is this incremental borrowing rate? If today I purchase this apartment as a lessee, if I'm not a tenant, rather I become the owner. If I purchase this, I'll take a loan. On that loan, how much cost I'm going to pay, how much finance cost I'm going to pay. That is incremental borrowing rate. So I need to first then use the incremental borrowing rate. Then what is right of use asset? Lease liability plus any payment made before or on the commencement of lease. That means any security deposit. So these landlords, they're always like, give us some security deposit. What if you paint the walls? They don't understand we are doing ACCA. We don't do such stuff. So they will ask you some security deposit, no? for any damage you may cause to their house. So that is also added into your right of use asset. So you get a right to use that asset. Right to use is there when you can direct the use of it. They can limit the scope of your lease. They can tell you that after 10 p.m., no party. After 10 p.m., no going out. That is allowed. But then you get to direct its use where you want to, stay. It's not like a hostel that they can assign you any room anytime. That is not lease. That is not rent. That's why you don't create an ROU in case of hostel, because room assignment is their task. But when you get to choose the asset, when you get to choose how you're going to use that asset, then it is ROU. And once you record the ROU, what is the subsequent treatment for ROU? You will depreciate it. Yes. So you'll depreciate it at lower of its life of the asset and the lease term. Yes. If you are guys, if you're planning to buy this asset after the lease term is over, so maybe you took this asset for 5 years, and after the 5 years are over, you're going to buy this asset, then you will depreciate the ROU over its life. Because when you'll buy it, no, you'll become owner. Then what do you do for lease liability subsequently? You unwind the interest. Yes, that's the only thing. So opening lease liability plus interest, this is finance cost which goes to P&L as an expense, minus the cash paid. I'm assuming the arrears situation. This gives me closing lease liability. Yes. Then if it is an advance situation, that means I'm paying rent in advance. Then opening lease liability minus the cash paid. Whatever net amount I get, on this net amount, I'm going to charge interest. That will give me closing lease liability. You also bifurcate it between current liability and non-current liability. If you have practiced a lot of questions by now, you know what I'm talking about, right? Okay. Then lesser accounting. Now we talk about this weird looking person, no offense. If anyone is a landlord here, no offense. This weird looking person who's the landlord, the lesser, how is he going to account for this lease? He will look at whether it's an operating lease or whether it is a financial lease. What is financial lease? If the life of the lease term is quite similar to the life of the asset, that means you have taken this particular property on rent for 5 years and the life of the asset is also 5 years. So practically you are going to use it for the full term. You're going to use it forever, right? So in this case, we say that it's a finance lease, not financial, it's a finance lease. Okay. It's a finance lease. So in case of finance lease, the lessor will de-recognize his asset and he will de-recognize asset and he will recognize a receivable. How will he treat the receivable? He will treat the receivable in the same way the lessee was treating the lease liability. Because the lessee is saying, I have a liability to pay. This is how I account for it. Lessor says, I have a receivable to receive. And this is how I account for it. Same way as you're accounting for your liability. Yes, like you're accounting for your liability, in the same way you're going to account for the receivable. Okay. Right. So this is my lesser accounting. What about my operating lease? Whenever he receives or accrues the rent, I don't know which language people are using in the chat box, but hi, I don't know the language. Hi. Accrues the rent. So he is going to record the income in the statement of profit and loss on the credit side. So this is what we are going to do in our lesser accounting. And lastly, from IFRS 16, we are going to talk about a deadly concept of sale and leaseback. I sell something, then I take it back on rent. I sell something, then I take it back on rent. What is this? Sale and leaseback. So I need to see whether the transfer is a sale. Transfer is a sale or the transfer is not a sale. transfer is not a sale. So guys, how do we know that it is a sale? Come back to IFRS 15. IFRS 15 talks about revenue. IFRS 15 talks about sale. It gives you the indicators of control being transferred. What are the indicators of control being transferred? Flashback. Risk and rewards are transferred. Ownership title is transferred. Money is received. Customer has accepted the goods. So that is few of the indicators of control being transferred, which you will have to, in SBR, you will have to judge it as per the case study, right? So if transfer is a sale, how will I account for it as per in the books of the lessee? Yes, lessee is the seller. He sells the asset and then he takes it back on rent. Then I'll talk about the lessor as well, who's the buyer. So he buys it and gives it back on rent. They have some kind of mood swings. Anyway, they want to do whatever they want to do. We are accountants, we have to deal with it. So they are selling something, taking it back on rent. This person is buying something and giving it back on rent to the seller only. So if this transfer accounts for as a sale, if this transfer accounts for as a sale, then what? What will the lessee do? What will the lessor do? If transfer is a sale, he will de-recognize the asset, de-recognize asset because he sold it. If he sold it, he will record a receivable also because money is going to flow to him, or maybe he will debit his bank. And then he will do his lessee accounting. What is the lessee accounting? Lessee accounting is he will create an ROU, he will create a lease liability, and he will calculate profit on disposal. How will he calculate this profit on disposal? He will pass this journal entry, and this would be the balancing figure. And how will he calculate lease liability? Present value of lease payments is the lease liability, but how is ROU calculated in case of sale and leaseback? Come on, how is ROU calculated in sale and leaseback? My students know this. Yes. How is ROU calculated? It is calculated as PV over FV into CA. So in the question, you find the present value of lease payments, that is the lease liability, divided with the fair value of the asset, multiply it with the carrying amount of the asset, you get the ROU. So bank debit because money flows in, asset credit at its carrying amount because it's bye-bye to the asset, we're leaving it, ROU debit because we have taken it back on rent, lease liability credit because we are going to make the payment of rent. ROU is calculated as PV over FV into CA. Balancing figure is your profit or loss on disposal. That's what you do for when transfer is a sale. What will the buyer do then? Buyer is going to simply record the asset. He will recognize the asset because he's received it now. It's a sale, so it's his asset now. And he will record a payable because he's going to make the payments. He's the someone who's going to credit the bank. He's the buyer. So when you buy something, you make the payment. So he's going to record a payment. And then he will do his lesser accounting based upon operational lease or finance lease. Simple lesser accounting. That's it. Then what to do when transfer is not a sale? When transfer is not a sale, do not de-recognize the asset. Yes, do not de-recognize the asset. Keep on recording it. But since you're receiving money, if you receive money out of nowhere, you say it's your financial liability. It's a loan. So financial liability will be recorded. Whatever rent you're going to pay, that would be treated as interest on loan. Yes. And what will the lessor do? The lessor simply is going to record a financial asset because he has given the loan. If you give loan to anyone, that's your asset because you'll get the repayment of principal and interest. So financial asset will be recorded. Then he will record rent received as finance income. And that's it. Yes, that's it. One more thing. One last question from leases. One last question from leases. When the transfer is a sale and the sale is above fair value, that means you received more money as opposed to the fair value. The extra amount that you receive in your journal entry, the journal entry remains same. In this situation, I assume the sale was at fair value. If you receive extra amount, that becomes your, if you receive extra amount, that becomes your financial liability. That becomes your financial liability. So any extra amount, if transfer is above fair value, it is your financial liability, the extra amount that you receive. If transfer is below fair value, then it is prepayment. Just remember that concept. That's it. So we are done with sale and leaseback and IFRS 16 as a whole. Now we will start with IFRS 9 financial instruments. Okay. So before I start with this deadly yet cute standard, let's take a break of next 10 minutes. We'll get back after the break. Stay tuned. Keep the live open, okay? Don't leave it. You just have few days. So make sure you attend it live. Don't depend upon the recording. Then it's just accumulation of another video. So stay tuned. Let's meet after 10 minutes from now. Am I audible to you guys? Mic check. Are we live? Are we audible? Yes. Let's resume. Is everyone back from the break? Yes. Okay. Let us resume with our session and let's begin with IFRS 9 financial instruments. So, IFRS 9 talks about initial treatment of financial instruments. What is a financial instrument? It's either a financial asset or it is a financial liability. So what do I mean by financial asset? Financial asset is the contractual right. It's a contractual right to receive the payment. This contractual right can be that you're supposed to receive payment in terms of a debenture. That means you have purchased a bond of a company. So you are supposed to receive money from that company. So that's a contractual right. You're going to receive money. Yes. So that is that is contractual right. So that's a financial asset. In case of SBR case studies, you'll find such situation where there is maybe cryptocurrency. Why is not it a financial asset? Because you don't have contractual right. There's no counterparty who's going to say that, dude, I'm going to pay you this much money. There's no contract, there's no right. Cryptocurrency is like a speculation. Either you receive money or you'll not receive money. You are in the gray zone. So it's like that betting which you are doing. That's why cryptocurrency is not a financial asset, right? Then, what is a financial liability? Financial liability is contractual obligation. So, contractual obligation does not mean legal obligation, or contractual obligation does not mean constructive obligation. Contractual obligation is obligation by contract, which means, like, if I've issued debentures. Debenture is a contract. So you collect money from the investors in form of debt. You all must be watching Shark Tank, I suppose. So you know how the sharks sometimes give equity and sometimes they give debt. So when they give that debt to the investee, that is what I'm talking about. That's a contractual obligation. The person has to repay that money. That's financial liability. So initially, IFRS 9 says record all the financial instruments at fair value and capitalize the transaction cost unless the method followed is fair value through P&L subsequently. Why did I write minus here? Why capitalization transaction cost minus? Because in case of financial liability, if I ask you to capitalize transaction cost, you're supposed to deduct the transaction cost from your financial liability. Why? Because capitalization is a happy process. When will you be happy? When the liabilities are high or when the liabilities are low? Of course, when the liabilities are low. So that's why when you have to capitalize transaction cost, you're supposed to deduct it from the financial liability. Then, what's the subsequent accounting treatment? Everyone should make notes along with me. Whatever you're doing, stop doing that. Take out your copies, make notes with me. First, we'll talk about financial assets. There are two types of financial assets. One is debt instrument, another is equity instrument. So subsequently, how do I treat my debt instruments? They are kept under either amortized cost method, or they are kept under fair value through OCI method, or they are kept under fair value through P&L method. How do we decide which method to choose? Let a part be what is the content of this method. How do we choose which method? Two tests: contractual cash flow test and business model test. Yes, business model test. What is CCF test? That I will receive any benefits only in cash, nothing in kind. So whether it's principal payment, interest payment, I will get money, I will get cash. I will not get in kind. So only one situation where you get benefit in kind is a convertible debenture, because then you get an option to convert that loan note into share. That's convertible. There's an option. Option is in kind. It's a benefit in kind, not cash. That's why CCF test in case of convertible debenture is not met, and it is kept under the dustbin method of fair value through P&L. So fair value through P&L is the most underrated method, right? And that is basically Dustbin of IFRS 9. So anything which you don't like, put it in fair value through P&L. Then comes the business model test, which talks about your intention. Why did you get into this relation with your financial asset? Was your intention for long term? Was it till maturity? Are you a good loyal person who wants to hold that asset till maturity? Then keep it at cost. No need to take it to its fair value. Then you rely on that person. You're like, whatsoever you are, you'll accept it. Amortized cost. But then, if you are in I don't know situation, you're like, I might keep it till maturity. I might consider some other investment. Maybe I can sell it whenever I feel like, whenever I get a good price. Then you keep it under fair value through OCI method. You take it to its fair value at each reporting date, but the gain or loss goes via OCI because you might keep it till maturity, no? So you might keep it for longer term. Conceptual framework, refer back, measurement basis. I told you that if you plan on to keep anything for a longer duration, you must keep it at cost. But here we are planning to sell also, but we are not sure of it. So we are taking it to fair value, but we are saying, let's not make our P&L fluctuating. Let's take the gain or loss via OCI. Then, if you are very sure it's a time pass, short term, if you're very sure that it's a time pass, short term, then what is this? This is gonna be the dustbin method, fair value through profit and loss. So this is how you decide on the three methods. And in amortized cost, you use effective rate of interest. What's your amortized cost table? Opening asset plus interest minus the cash received gives me the closing asset. And this interest is the effective rate of interest, which is used to accrue my financial income. Then I have fair value through OCI. In fair value through OCI, first make amortized cost table. I copy the interest column from there and I put it in the fair value through OCI table. At each year end, I take the asset to its fair value and the movement goes via OCI. That's it. Fair value through P&L is self-explanatory that you have to keep it at fair value and the movement goes via P&L. Then comes equity. For equity, we have two methods. Fair value through profit and loss, fair value through OCI. By default method is fair value through P&L. If nothing is given, you assume it to be P&L. Why? Because usually you hold shares for trading. How many of you are here intraday traders? Many? At least planning or know about this term. People buy and sell shares like anything. They will buy it today, 9 a.m., 10 a.m., they'll sell it before 3 p.m. So that is trading which is happening with the shares. If you even sell it after 1 week, 2 weeks, that is also trading. So keep it at fair value because you're going to sell it very soon and take the gain or loss via P&L because you need to keep a check on its fair value. But when do you keep it under OCI? Only if two conditions are met. Condition number 1, must not be held for trading. Yes. And second, irrevocable choice was made upon designation. Come on. What is this? When this financial asset was born in my financial statements, that means upon the date of designation, I decided this asset is going to be kept under fair value through OCI. Just like your parents, when you are born, they are like, my child will become IAS, my child will become engineer, doctor. So the day this asset was born in the financial statement, the accountant decided I will keep it under fair value through OCI. So in the SBR case studies, you'll find out that even though the asset was held for trading in short term, still the accountant being the accountant, you know how accountant is in SBR, always making mistakes, and then you point out his ethics. So he being the accountant, he simply said that yes, even though it is held for trading, I designate it under fair value through OCI, and you point it out. Unethical accountant. He didn't attend TG Prof's SBR classes. He does not know what is IFRS 9 telling. IFRS 9 says if it is held for trading, you are not supposed to keep it under OCI because then you're selling it in short term and you must record it at fair value. And since you are selling it in short term, you need to show your profit and losses in statement of profit and loss. So that is it about our equity. Then come to convertible debentures. See, when you issue convertible debentures, I'm talking about issue. When you buy convertible debentures, they're kept under fair value through P&L because CCF test is not met. But if I talk about when I issue convertible debentures, yes, when we issue convertible debenture, what is the treatment? What is the treatment? Split. Split accounting. Split it between what part of it is financial liability, what part of it is equity. What is the financial liability? Present value of future cash flows is the financial liability. What rate? Highlight. What rate do you use to calculate this present value? Interest rate of similar bonds with without conversion options. So if similar bond was there and it didn't have conversion option, then what would the interest rate of that bond be? That is going to be your interest rate for present value discounting, right? So this is what you do for convertible debentures. You split account, you calculate financial liability. Then the equity is the balancing figure. Yes. And then thereafter, equity subsequent treatment is nothing, either fair value through P&L. This is the equity that is issued. This is the share capital or the share premium. This is not asset. Financial liability, you have further accounting treatment. Let's talk about accounting treatment of financial liability. What is the financial liabilities accounting treatment? Come on. Amortized cost by default. FR students are till here only. They close their books here only. Okay. There's lucky people, no? But SBR students, you have one more thing. Fair value through P&L. So FR students, ignore from here. Ignore me from here. Come back on group accounts after this. Ignore me from here. You're done with your financial instruments. That's it for you. Come back in few minutes for uh your group accounts. SBR students, let's continue. Fair value through profit and loss. See, you keep your liability under P&L. If you hold it for trading, which is very rare. Nobody trades with their liability. Imagine I say I have a loan of 10 million. Can you please pay it on my behalf? Joke. Okay. So this is not there. But for sake of avoiding, for the sake of avoiding an accounting mismatch, yes, for the sake of avoiding an accounting mismatch, sometimes we keep the liability also under P&L. Imagine you bought an investment property and for that you took a loan. So that investment property is kept under fair value through P&L. So the standard says, dude, matching concept. You take the gain or loss of that that investment property via P&L, but the loan that you took for that, why are you not taking that gain or loss via P&L? How will the investor know? Then you'll ask me, ma'am, investment property, liability, what's the big deal? They were born together, they're twins. They entered the accounting world together. You passed a journal entry. The day you pass a journal entry of two things together, two account balances together, they become related. As per spirit of IFRS. It's not the words, it's the spirit. So they become related. I passed a journal entry, IP, investment property debit, liability credit. Now you can't say they will live separately. Investment property will enjoy IAS 40, financial liability will enjoy IFRS 9. Yes, they will, but somehow they are still related. Yes, so that's why they are related. And if one thing is kept under P&L, the other thing must also be kept under P&L. Then they say, in this case of financial liability, we are done with the subsequent treatments. Okay. We are done with the subsequent treatment. Let us now talk about impairment of financial assets. Also, I'll just take 1 minute to it came into my mind. After the class, if you guys want to be part of a WhatsApp group, make sure you WhatsApp me on this number, because just in case on the day of exam or anything like that, if you have any issues or if you want to get some notes or something help, you can WhatsApp on this number right away. You'll get the link. That's an automated message you get. And also for SBR students, there's a podcast on Spotify, which is again free of cost. Please do listen to that also before your exam, not because I want to market it. I don't get any money from there, okay? I don't even get any monetary benefit from here. I'm telling you this because here I have discovered and discussed about some answer writing techniques on pre-populated spreadsheet and stuff. So you can find me with by the name of IFRS with TG on Spotify if it works in your country. Let's resume. Impairment of financial assets. If I talk about it, I am supposed to create a loss allowance. So in your class 11th and 12th, I'm sure you guys must have heard about something known as doubtful debt. One is bad debt, another is doubtful debt. So in IFRS, we have given them post word. Doubtful debt is loss allowance. And bad debt is credit impairment. So when we have any doubtful debt, so you always keep this kind of a expression. When you've given loan to someone, you always doubt them. So you always, look for any indicators of impairment. So you can create two kinds of loss allowances: 12-month expected loss allowance and lifetime expected loss allowance. And this is only created on debt instruments, debt financial assets, which are kept under amortized cost or which are kept under fair value through OCI. These are the only two methods. When you create a loss allowance, you create 12-month expected loss allowance if the credit risk since inception has not increased significantly. What is the credit risk? What is the credit risk? The risk of non-repayment. What if I won't be able to repay back my principal and interest? That is the credit risk. So if the credit risk has not increased significantly, we say yes. Let's create a 12-month expected loss allowance. If the credit risk has increased significantly since the day of inception, since the day this asset was born, then you're supposed to create a lifetime expected loss allowance. So 12-month, as the word suggests, you imagine, you doubt the person. Let's suppose Mr. Ram gave a loan to Mr. Sham and he keeps on doubting Mr. Sham. What bad things can happen to him in 12 months which will lead to non-repayment? When Mr. Ram doubts like this on Mr. Sham, that is 12-month expected loss allowance. When he assumes what all bad things can happen during the course of the loan, 3 years is the course, let's suppose, then that is lifetime expected. So whenever you create a loss allowance, you need to make sure that the loss allowance is at present value. The loss allowance is probability weighted. Yes, and the loss allowance is always created by a statement of profit and loss. Your entry is statement of profit and loss debit, loss allowance credit. But one exception, as usual, they don't make our life easy in SBR. That's why you need me. No. So, what is that? This is when you have any debt instrument which was kept under amortized cost. In that case, it's simple. P&L debit, loss allowance credit. But in case of debt instruments kept under fair value through OCI, you have some rules. You say, as per the standard, you're already recording this instrument at its fair value. So let's suppose the debt instrument was of $1,000 in the beginning of the year. Its fair value has declined to, let's assume 900. So you will say, ma'am, loss 100. As per the standard, this loss will go via OCI. So I took this whole loss via OCI. Yes. But then in the question, they got a mood swing and they said there's a loss allowance also. Okay. What's the loss allowance amount? They said loss allowance amount is $55. Loss is 100. Movement of fair value is 100. But these guys are also giving us a loss allowance to be created of 55. So what should I do? Should I reduce 55 from here? Or should I assume this 55 is already there within this 100? Is it within this 100? Yes, it is within this 100. Because the standard says you cannot record your asset at a lower amount than its fair value. You can't take it below 900. 900 is the fair value. You can't take it below 900. That's the rule. Okay. So what you do? You say 100 already went to OCI. Take out 55 out of this. So you will bifurcate 100 into 55 and 45. You will say 45 goes into OCI as a loss. 55 as loss allowance will go to statement of profit and loss. So your entry will be P&L debit 55. Okay. Then OCI debit 45. Asset credit 100. Because there's a loss of 100. So this is how you treat your loss allowance in case of debt instruments kept under fair value through OCI. If you did not understand, please rewind, listen it again, that's fine. Let's move on. Okay, so we are done with the impairment part. So in credit impairment, bad debt, yes. So in credit impairment, we have a situation where a bad debt was there, where the counterparty has said, I'm not going to pay you back. There's a guarantee, I'm not going to pay you back. He's made us sure that now he's bankrupt, he's not giving it back. So now what to do? This is a bad debt. You need to record a loss. So your entry is P&L debit, asset credit. Previously, your entry was P&L debit, loss allowance credit. So when you credit your asset, now your next year's interest will be at net amount. Net amount means after reducing this loss. Gross amount means without reducing the loss. So in loss allowance, I calculate the interest on the gross amount. But in credit impairment, I calculate the interest on net amount. Right? And then also, they say if you purchase any credit impaired asset, purchase credit impaired asset. What's that? If an asset was already credit impaired, why would I buy it? If the person has said they're not going to repay, why would I buy it? Have you heard about debt recovering agencies? What do they do? People have said, yes. So people have said that they are not going to repay, but still these debt recovering agencies will come like, God, we will save your money. Give your receivable to us. We will collect. We will threaten him. We'll get back your money. So in the same cases, such people exist in the market also. The company is saying, I don't have money. They're like, no, no, we know you'll pay. How? Because see, if a company says, I'm not going to pay, their debenture or their bond, the fair value decreases. So I can buy it at a lower price as a secondary user. I'm not talking about the users who bought that IPO kind of a thing, not the initial purchasers. I'm talking about secondary market. So there I can buy it at a lower price. Maybe in future there is a hope that they will repay. So in that hope you buy it. And that means you're purchasing a credit impaired asset. So for this, IFRS 9 gives you a rule that you are supposed to use CIAR, credit impairment adjusted rate, for your calculation of interest in your amortized cost table. So you all know you need the interest rate, effective rate of interest. But in this case of purchase of credit impaired asset, you're going to use CIAR. That's the rule, right? That's the rule. That's it. So we are done with our impairment of financial assets. Let's come to derivatives. I hope no FR student is here and crying. This is not for you. Please. It was back done in subsequent treatment of financial liability only. This is all for the SBR students. Okay. So let's talk about derivatives. So derivatives, they say, is anything who will be settled at a future date. Yes, that's one feature of a derivative. Second feature of the derivative is that it has initial zero or very less amount. Third feature is its value is dependent upon an underlying factor, underlying item or underlying factor. Yes, that's what I mean by the derivative. And the standard says you need to keep the derivative at fair value through profit and loss. That's it. Whether it's a share option, whether it's a swap, whether it's any forward contract, future contract, it's a derivative because these features are met there. And you need to keep it under fair value to pre and L. Sometimes in SBR case studies, you will find something would feel like a derivative, but you will be entering into that future contract to get its delivery in the business. You want to take its delivery in the business. For example, you enter into a contract to buy electricity in future, but you have a factory. You set a predetermined price that I will buy electricity from this person in future. We say this is a future contract. It's a derivative, fair value through P&L. But again, the case study turns the tables as usual. Examiner is very mood swings happens to the examiner. He says you're going to take the delivery of the electricity in your company. You want to use it for your own purpose in the business. You want electricity not for speculation, but for your business. So if you want electricity for your own purpose and not for speculation, then we call such a contract. We call such a contract as executory contract. Yes. Executory contract, which is not recorded because we will enter into it in future. So why to record it today? It's not for speculation, so it's not derivative. We want to use it in our own business. So that's an executory contract. We record it the day we actually get the delivery of that electricity in our business. It will be treated as a normal purchase. So if you don't speculate, if you enter into a transaction just for the purpose of business, then that's executory contract and not a derivative. Okay, let's go on. The favorite topic for everyone. Yes. Favorite topic for everyone. Hedging. What is hedging? When you buy something, if you have an hedged item, I always give this example that if you, let's suppose you have a receivable, like you have to, or payable, you have to make a payment to ACCA in future in GBP, but you live in India, so your currency is INR. So you'll be making a payment in future. So you have a foreign currency risk that I know if I make the payment today, this much INR I will pay, but if I make the payment after 3 months, maybe the amount will increase. So you have a fear. What if the amount increases? Just like you have a fear, what if I don't pass? So when you have a fear and you bet on that fear, you say, even if this fear happens, if it comes back to reality, I will be able to hedge by getting into a hedging instrument, by buying a hedging instrument. So that is basically like, I fear that the exchange rate between pounds and GBP will change. Okay, so maybe 1 GBP today is equal to 85 Indian rupees. But I fear, what if it increases? What if 1 GBP will be equal to INR 100 someday? I'll pay more then. I'll have to pay more. So you fear that. So you buy such a derivative, you buy such a hedging instrument where you safeguard yourself from this risk. If this turns out to be the reality, if your fear turns out to be true, then you will make a gain on that. So it's like if this situation comes out to be true, you'll make a loss on the hedged item, that is your payable. You'll make a loss there, but you'll make a gain here. And you will, at the end of the day, come back to net, no loss, no gain situation. This loss will be settled off against this gain. This is hedging, right? So whenever you enter into a hedging transaction, there are two things. First, you need to recognize, you're supposed to recognize the hedged item. Then you're supposed to recognize the hedging instrument. Okay, you need to name them. Birth certificate is created for both of them. And then you document them also. And we also designate whether it's a fair value hedge or is it a cash flow hedge. What is the accounting treatment of fair value hedge and cash flow hedge? Fair value hedge. I'll not go into the meaning of it. Let's know the accounting treatment only when you are hedging yourself against the fair value fluctuations. That's fair value hedge. So fair value hedge says the hedging instrument and the hedging item both will be taken to their fair value. Yes. And the gain or loss will go via statement of profit and loss. That's what happens in fair value hedge. That's what happens in fair value hedge. But when I talk about one exception, what's that exception? If my item, hedged item, is equity instrument which was kept under fair value through OCI, then the gain or loss will go via OCI. That's the only exception. This is what happens in fair value hedge. Then a very interesting hedge, cash flow hedge. What happens in cash flow hedge? You talk about effective and ineffective gains, effective and ineffective. So remember that sibling example, all the students who are enrolled with me and anyone who's attempted or listened to the podcast on Spotify, you know this example. What is this example? Yes. What's this example? Elder sibling, younger sibling. So usually parents, I'm not offending anyone. I am myself a younger child at my place, at my home, not place. Okay. So I have my elder brother. So he was getting bored. 5 years later, my parents decided just to accompany him, there should be someone so that he doesn't get bored. So that's how I was entered. I entered this world. So what was the reason or the objective to bring me? Imagine I am playing the role of hedging instrument and my brother is playing the role of hedged item. So he was the main focus, just to accompany him, just to play cards with him and that block game with him. The instrument was purchased. So what's my objective? Just to accompany him, right? So that he doesn't get bored while playing is that Ludo and all those things. So that means this is the objective of the instrument. What is the objective of hedging instrument in reality? To net off the gain or loss of the hedged item. Imagine a situation where hedged item just created a loss of $100, but the instrument made a gain of $1,000. So you bought this instrument for the purpose of what? To net off the gain or loss with the item. The parents brought the younger sibling into the world. Why? Just to accompany the elder sibling. So imagine the younger sibling is troubling them more. What would the line be from the parents? They will say, useless. Why did we bring him to the world or her to the world? She's troubling us more than the elder one. Elder one is so sweet. Elder one is so good. Younger one is troubling us so much. That's what they say, no? That's the reason is they say this because they consider you ineffective then. Their objective was to just accompany him. If he is playing, you just need to play with him. You're not supposed to trouble them extra. So if the gain or loss made by the instrument, if the gain or loss made by the instrument is greater than the gain or loss made by the item, that extra gain or loss is known as ineffective portion. So the effective portion goes via OCI and the ineffective portion goes via P&L. That is cash flow hedge, right? That is cash flow hedge. So this is the rule of hedging and that's it that you should know from hedging. There are more parts to it, hedge effectiveness, blah, blah. But these are the important parts. Are you guys clear on this? Come on, quick yes or no. Are we alive? High on energy, low on energy. Come on, have a cup of coffee. Are we clear? Yes, are you telling about yourself, ma'am? Yes, yes, I am. Awesome. Okay, good. Let's move on. Please, someone call FR students. We are starting with group accounts. So all the FR students, back to the game, back to the field. Group accounts. After listening to the groups, all the FR students, you can log out. We will be done with the day, basic groups, okay? So let us start with our group accounts. So in consolidation, basic group accounts, we have three principles of preparation of consolidated accounts. Add up everything at 100% as if you own everything. Then you are supposed to, find the intra-group transactions and eliminate them. Lastly, you are supposed to show NCI. That is the control that you don't have in that company. What I'm talking about? I'm talking about parent and subsidiary, right? Parent has control over the subsidiary. What is the definition of control in SBI? You'll have to write the definition of control as it is. A, power over the investee. B, right over the variable returns. Right means that I will have share in profit or losses. I'll be with you in your good and the bad times. That is when you control someone. C is you have the ability to affect those returns. You just don't have shares. By making your decisions, key operating and financing decisions, you can even affect whether a company will make a profit or a loss. That is when you have control, right? So control exists. Then you are supposed to consolidate. So what kind of consolidated accounts we prepare? We prepare consolidated statement of financial position. We prepare consolidated statement of profit and loss. We prepare consolidated statement of cash flow. In FR, we don't have this, but in SBR, we have this. And I suppose that this time maybe, okay, we are not predicting, maybe cash flow won't be there because it was there in December attempt. So we are just supposing it, but still we should cover it. No cherry picking in SBR. Everything should be covered. If you have not done it yet, please do it. I've done solved the December 2023 past paper on cash flow, which was there. It's there in the live section of my YouTube channel. You can just visit it, day 2 of the marathon. Then we have group balance sheet, group P&L, and statement of cash flow. So here what we have is, I am supposed to prepare the balance sheet where I will add parent and subsidiaries result at 100%. I do not record subsidiary share capital. I do not record in the parent's accounts if it has made any investment in the subsidiary. So in the individual account, parent must have recorded investment in subsidiary financial asset. I'll not record it in group accounts. Subsidiary must have recorded the share capital. I will not record it in group accounts. So for the balance sheet, we have 5 working notes. Quickly, working note number 1, group structure. Who's the parent? Who's the subsidiary? Identify. SBR students, how do you identify the acquirer? How do you identify the acquirer? The bigger company is the acquirer. The person who has paid cash, issued share capital is the acquirer, right? The company which is having more profits usually is the acquirer. Yes? So this is what I mean by group structure. Then I even have sometimes associates within this. What is associate? A person who has significant influence. Significant influence means power, or significant influence means control? No, it means power over or power to participate. Your friends are your associates, no? They don't have control over you. They can't control which university you are going into, which job you are applying into, but they participate in that. They influence you in a certain way. They are just like your, friends are proper examples of associates. So here we usually have the share range of, if we have a share capital or voting right of 20 to 50%, we usually say it's an associate. If the share holding is more than 50%, we usually say it's parent. But there are some situations where we might have less than 50% and still we are the parent. What are those situations? Maybe you are appointing majority of the board of directors situation. Maybe you are, you are making key decisions. You share key management personnel. You are appointing the key management personnel for the subsidiary. So that also gives you control, right? So this is what I mean by associate, and how this is what I mean by control. And how do we treat associate? IS 28 equity method of accounting. That means one line accounting. What is equity method of accounting? where in my balance sheet I show cost of investment in associate, and in my P&L I show share of profit in associate. Yes, that's how you calculate your figures in P&L and balance sheet. Then let us talk about second working note for group balance sheet. Fair value of net assets of the subsidiary. What are net assets? Net assets are the equity section of any company. Net assets are the worth of that company. So you need to calculate. We're supposed to take the fair value. So I'll take the net assets at the date of acquisition. I'll take the net assets at the reporting date. The movement between this and this is the post-acquisition movement, which is basically in which you have share. The parent and NCI will have a share in this. Yes? So you all have done group accounts, you know, share capital, share premium, revaluation surplus, retained earnings, all are these types of net assets. Fair value adjustment will be adjusted here also, here also. So impact on post acquisition will be 0. Then due to this fair value adjustment, there might be some additional depreciation. I'm just revising the concept, so I hope you know what I'm talking about. So this additional depreciation will just be reduced from the reporting date column. So it will impact post-acquisition column as well, because depreciation is a subsequent event. It happens at the reporting date. It's the year-end adjustment, right? So that's why this is how I prepare my working note number 2. Then working note number 3, goodwill. What is the formula of goodwill? Let's write the basic formula. Fair value of consideration. Fair value of consideration paid by the parent and fair value of consideration paid by the, or whatever is the NCI's amount. It depends what you take as NCI. Do you take NCI at fair value, or do you take NCI as percentage of working note number 2? That is dependent upon the case study. Do they want full goodwill or do they want proportionate goodwill? Right? Yes. So this is what is there in our working note number 3. From this you deduct fair value of net assets of the subsidiary at the date of acquisition. And from where do you get this? Working note number 2. This gives you goodwill on acquisition. If it's a positive goodwill, it becomes your intangible asset, which is held for annual impairment review. If it becomes negative goodwill, if it is a negative goodwill, then what? This negative goodwill is recorded in working note number 5 as gain on bargain purchase. Yes, it's recorded as gain on bargain purchase. That's the accounting treatment of goodwill. Now, there are 2 types of goodwill. Full goodwill, proportionate goodwill. In proportionate goodwill, NCI is calculated as percentage of working note number 2. In full goodwill, NCI's fair value is taken into account. So when you take NCI's fair value into account, that is the only situation you will allocate goodwill impairment to NCI also. If you have not taken NCI's fair value, so you're not supposed to allocate any impairment to NCI. So in case of proportionate goodwill, if there will be impairment of goodwill, will it be allocated to NCI? No. Now specifically for SBR students, FR students, close your ears for a minute. Specifically for SBR students, in proportionate goodwill. Yes, in proportionate goodwill. If you want to look for the impairment, so as per IS 36, if you are talking about a cash generating unit, so goodwill is like a corporate asset. No, it's omnipresent in all the CGUs. CGU is the smallest group of identifiable assets which generate cash flow independently. Like they don't generate independently, they generate together. So to all CGUs, goodwill is allocated. How do you impair the CGU? You look at the carrying amount of the CGU and you look at the recoverable amount of the CGU. Recoverable amount comes from the market. So in the carrying amount of the CGU, you have recorded proportionate goodwill. That means only 80%, assuming 80% is the control. So you have just recorded 80% of the goodwill, but market does not know about your calculation of goodwill. They have included it at 100% in the recoverable amount. So is this like for like comparison when you compare 80% with 100%? No. So this is not like for like. So what we do? We first bring this carrying amount. For this, we bring that 80% goodwill to 100% of goodwill. So you gross it up. You need to gross it up. Use unitary method and gross it up. That is known as total notional goodwill. Now use this total notional goodwill to calculate actual impairment. Now compare 100% with 100%. You will get 100% of the impairment. But in your accounts, you will just record 80% of the impairment because you recorded 80% of the goodwill. So this is the concept of working note number 3. Goodwill calculation. Right? So I hope we all are clear on goodwill calculation. Yes. Are we all clear? Come on, quick. Are we all clear on goodwill? Yes. Awesome. That's the energy. Good. Let's get back. Working note number 4. Working note number 4. NCI. I need to take NCI as per what I took NCI as amount in working note number 3, whether it was at fair value or whether it was as a percentage of working note number 2, whatever it was, take NCI as amount, add NCI share of post acquisition profits or post acquisition movement in net assets of subsidiary. And if it was fair value of NCI, also show the NCI's percentage in goodwill impairment. Yes. So that's how you prepare your working note number 4. You get NCI at reporting date. Then lastly, you have working note number 5, which is group retained earnings. So you start with parents' retained earnings. They are recorded at 100%. Then you show parent share in subsidiaries post-acquisition movement. Then percentage of parent in the goodwill impairment. Then if there was any deferred consideration initially, you must have calculated it at present value. Present value means further unwinding of interest. So even that is deducted from here. So unwinding of interest happens if there was any provision recorded, even that is deducted. So like this, based upon the case study, whatever is to be adjusted in the retained earnings, you make it at working note number 5 and you get your closing retained earnings of the whole group. That's it about the basics of group accounts, 5 working notes. Right? Now the question comes, one quick question to everyone. What are the danger items? That means these items are not recorded in individual accounts but are only recorded in the consolidated accounts of the subsidiary. So in individual accounts of subsidiary, these things are not there, but they are present in the consolidated accounts. What are the danger items? Yes. Come on. What are the danger items? Very good. Brand. Contingent liability. Yes. So if there was any internally generated brand, it is not recorded in individual accounts, but is recorded in consolidated accounts. And even the contingent liability, as per IS 37, was recorded, was just disclosed, but on consolidation, you record it. Yes, so these are the danger items that you have to keep in mind in consolidation process. Now let's talk about intra-group transactions. Intra-group transactions. When the parent is selling goods to the subsidiary, it can be either at a markup or it can be at margin. What is markup? Markup is always at cost. What is margin? Margin is always at selling price, right? Markup and margin. When parent sells goods to the subsidiary, parent has recorded unnecessary profit, which I will remove from GRE, and subsidiaries inventory is overstated, so I'll credit inventory by the amount of PURP. What is PURP? PURP is the profit on the goods which are still within the group. If parent sold goods to the subsidiary, if those goods are still within this territory, we say that the inventory is still there with the subsidiary. The inventory has not gone outside. The profit is still unrealized, right? That's why we calculate the PURP and we make the adjustment. So what's the adjustment? When parent is the seller, GRE debit. That means working note number 5 will see a deduction. Group inventory credit. When subsidiary is the seller, come on, what happens? Working note number 2 is adjusted. Okay, at the reporting date, you deduct the PURP from your net assets. So working note number 2 debit and corresponding effect is on the group inventory. So this is what happens when the subsidiary is the seller, right? This is all about our intra-group transactions. Awesome. Now, what is the effect of intra-group transaction on group statement of profit and loss? What is the effect of intra-group transaction on group P&L? We say that please calculate what was your group revenue. Okay. What was your group revenue? Please calculate which was intra-group revenue. What was your group purchases? That is basically the amount of intra-group transaction. We are not talking about PURP. We are talking about actual amount of sale that was made by the parent to the subsidiary or by the subsidiary to the parent. Quantify that, remove that from the group revenue and remove that amount from group cost of sales. Okay. And then add PURP to cost of sales. Why do you add PURP to cost of sales? Because you need to remove, okay, you need to remove the profit. How can you remove the profit? Increase the costs. That's another way of removing the profit. So add PURP to cost of sales. So this is how we record or we make our group P&L. And just one another aspect of P&L. In the group P&L, guys, just remember that you are supposed to time a portion. I would say you are supposed to time a portion the results. If you bought the subsidiary mid-year, so usually mid-year is 1st July, okay? So if you have started your year on 1st January, but you purchased the subsidiary mid-year, that means you will just have the shares in profits after the acquisition. So only the post-acquisition period would be 6 months. So all the income and expenses of the subsidiary will be consolidated just for 6 months. That's the rule. That's it about group statement of profit and loss. Yes. So I think all the FR students, you can thereby just smile and start revising all the standards apart from this. So this is all for the FR students. After this, only the SBR students would be there. I hope it was a helpful session for all the FR students. I just revised all the important concepts for you. I hope it was fruitful. All the best for your exam. May God bless you all. SBR students, wait. Okay. So that's it for FR students. Tata, bye bye. Okay. Let us move on with SBR concept. Change in group structure. Change in advanced aspect. Change in group structure. What's there? Remember that meme when Tom is going to the heaven, stairs which goes to heaven, draw those stairs. This is Tom. This is the door of control, 50%. Tom is going up to the heaven. When he has 0% to 10% to 20%, you say it's a normal financial asset, then under IFRS 9. So if you have normal investment ranging from 0 to 20%, that's your normal financial asset as per IFRS 9. If you have more than 20%, if you have between 20 to 50%, then it's an associate as per IS 28. When you cross this door of control, it becomes the parent. It becomes consolidation, right? It becomes the consolidation. Then, what next? If you move up these stairs, that is step acquisition. It's not always I was at 0 and suddenly I came at 70%. That's so unrealistic. You buy 10%, you buy 20%, then you buy 40%, then you buy 70%. It's piecemeal acquisition, step acquisition. So when you do this step acquisition, there are two situations. So let's talk about the situation of step acquisition. Two situations. What are these two situations? When I move from no control, when I move from no control to control. Another situation is when I move from control to control. So when I move from no control, when I move from no control to control, what I do, I calculate goodwill. So imagine you were previously having 20% interest. So that was IS 28. Now you have 70%. That means you bought 50% more shares. So now you are under IFRS 3. So it's like you say buy to IS 28 and hi to IFRS 3. How you say buy to someone? You fully realize them. So you take your investment in associate, the whole investment in associate is taken to its fair value. Okay. The gain or loss goes via P&L. Then you derecognize it and you calculate goodwill. Now apply IFRS 3. How do you calculate goodwill? What's the formula? Fair value of consideration paid to acquire extra 50% shares. Fair value of previously held interest of 20% plus NCI minus working note number 2. That's how you calculate goodwill in case of no control to control. That's the only implication. So it's just that you should know how to say bye to IS 28 and how to say hi to IFRS 3. Right? Then, what do we have? Control to control. What happens in this case? You were already having 60%. Now you acquire 10% more. So now you have 70%. That does not impact your control position. You were already a parent. Now you just are a parent by 70%. So in that case, only implication is on NCI. My non-controlling interest was 40% here, and now my non-controlling interest is just 30%. That has decreased. That is decreased. So how will you calculate this decrease in NCI? And how will you adjust it? Come on, tell me, how are you going to calculate the decrease? How are we going to calculate the decrease in NCI? Yes. How will you calculate the the decrease in NCI? Are you out for a coffee or what? Come on, reply. Unitary method. Very good. So I will apply unitary method. How do I apply unitary method? I say, what was my NCI prior to this acquisition? So my 40% of NCI was $1,000. 1% would be 1,000 divided by 40%. I need to calculate what is 30%. So my 30% would be 1,000 divided by 40% into 30%. So that is my 30% NCI. Calculate the decrease and you will get the amount, right? Another way of calculation of NCI is, what is this acquisition date is there. So what was in this case you only have this method because you don't have any goodwill recorded, net assets recorded, so you just use this method for unitary method. I will tell you another way when I talk about step disposal. So this is what I do in control to control, but what is the journal entry of it? When you acquire more shares, you pay out money, cash goes out. So you say, my NCI decreased by whatever amount, I paid money, so bank credit, but they won't match. Maybe NCI reduced by 1200 and to acquire the subsidiary you paid 1000. So by paying 1000, I got rid of a headache of 1200. I made a gain. This gain is recorded in other components of equity, which is the balancing figure, right? So this is what you do in control to control step acquisition. Next comes the situation when we move down the stairs. Yes, situation when we move down the stairs, step disposal. Once again, two scenarios: control to control, control to no control. So control to control is, your NCI will increase. You were having 80% shares in a subsidiary. Now you're just left with 60%. So you dispose 20%. Your NCI here was 20. Your NCI here is 40. So your NCI has increased. Your headache has increased, right? That is the situation of control to control. So what do? You calculate NCI at disposal date. So let's suppose the disposal date NCI as per the question, which was 20% of the NCI, was 1000. Use unitary method. Calculate, because my NCI is increasing to 40%. Calculate what would be the increased NCI. That would be the change. So let's suppose gross it up. You'll get the amount. How do you gross up? You say 20% is 1000. 1% would be 1000 divided by 20. 40% would be 1000 divided by 20 into 40. Whatever you get 2000. So the movement is increase in NCI is by 1000 only. Now another method of calculating this increase in NCI is, you take goodwill on disposal date plus net assets of the subsidiary at disposal date. You take goodwill only when you've calculated full goodwill, because then only NCI has a share in that. You take these two amounts, multiply this with the percentage of NCI. That can also be used to calculate your increase or decrease in NCI. That's something which we use usually because sometimes NCI at disposal date is not given to us. So we use this methodology to calculate the increase and decrease in NCI. And once again, what's the journal entry? Because you're disposing, bank money is coming in. So bank debit, NCI credit, okay, bank debit, NCI credit. If I received 1200, but my NCI increased by 1000, that means I incurred a gain of 200. Once again, goes via other components of equity. So this is what happens in control to control situation. But then the best situation, let's talk about control to no control. You need to calculate your gain or loss on disposal. How do you calculate your gain or loss on disposal? Come on, let's see. Happy sad formula. By selling something, you made some money. So proceeds, you must have received money. Maybe you disposed, you had 60% shares in a subsidiary. Now you just have 30%. So you disposed your 30%. So you move from control to no control. So you say happy about proceeds. Yes, you're happy about the proceeds received. Then what else you're happy about? When you dispose the company, you lost the control, you will stop consolidation, the NCI will be derecognized. NCI is a headache, mere headache. It's going up. I don't need this. So when NCI goes, you're happy. So NCI at disposal date, we are happy about it. Then what are we sad about? The goodwill of the company will also go. So goodwill at disposal date, deduct it. Yes, you're sad about losing it. Then also deduct net assets of the company at disposal date. Anything else you're happy about? You're still having 30% of interest in that company. It's just like you broke up, but you're still talking to the person. So you are a little bit comforted that, okay, I'm still talking. So you still have some interest in that business. So in that case, you're still happy about it. So you add retained interest. Yes. So this is our formula to calculate group profit or loss on disposal. Proceeds plus retained interest fair value plus NCI at disposal date minus goodwill at disposal date minus net assets of the subsidiary at the disposal date. Right? Yes. Are we guys clear? Come on. Quick yes or no? Are we all clear? Yes. Okay. Before we begin with the next part, let's take another break of 10 minutes. Then after the break, I'm going to resume with foreign subsidiary, Forex, statement of cash flow, and then I'll talk about IFRS 2 and IS 19. So let's meet after the break for these parts of your syllabus. 10 minutes, be back. I'll have a glass of water, you have a cup of coffee. See you all after 10 minutes. Yes, guys. I hope I'm audible to all of you. Let's resume. Are we back from the break? Hello, mic check. Are we back from the break? Awesome. Okay, guys, let's resume. Let's resume with our revision. So let's start with group foreign subsidiary. So first, I should know the rules of IS 21. Yes, that's a small standard. So, rules of IS 21, it states that when I'm talking about individual companies, I must know that if I have any receivable, payable, that is a monetary item abroad, that means it's a foreign currency difference which might be there, which will lead to fluctuations, will create exchange gain or losses. So, in case of individual accounts, we bifurcate monetary items, non monetary items. So the gain or loss on monetary items, see, you need to calculate what was your receivable on the date you recorded it and what was your receivable at the reporting date with the new exchange rate, which is the closing rate. So you use closing rate for monetary items. Is inventory a monetary item? Big cross. Inventory is not a monetary item. It's a non-monetary item. Anything which is readily convertible into cash is monetary item. So we will have monetary item. Okay, that's a receivable for us. We will take it to its closing rate. This will give rise to an exchange difference. This will give rise to an exchange gain or loss. And that exchange gain or loss is recorded via statement of profit and loss. It goes via P&L. That's the rule under IS 21. But when we talk about a group where there are parents and where there is a subsidiary, okay, so what if group is expanded abroad? What if there's a foreign subsidiary? What do we do? First we need to determine if subsidiary is autonomous or not. Yes, that's what you do. You spit out the facts from the case study. Is subsidiary autonomous of the parent? Is subsidiary very much dependent upon the parent? If yes, then parent's functional currency and subsidiary's functional currency is exactly the same. But if subsidiary is independent, that means subsidiary does not need the parent's funds to do its business and operations. Then we apply the factors to determine the functional currency. What is functional currency? Functional currency is the currency of primary economic environment. Yes, functional currency is the currency of primary economic environment. Right? We all understand this? Now, to determine this functional currency, I will apply the rules of IS 21, which are primary factors, which are secondary factors. What are the primary factors? The currency in which a company quotes its selling price. So, at TG Profs, at what price is the course listed? For Indian students, it's at INR. For all the students in the rest of the world, it's in USD. So the price in which you quote your selling prices is your functional currency. Majority of the selling prices. So majority of our students are from abroad. So we would say that, okay, in that case, our selling price is quoted in US dollars. So maybe functional currency for TG professionals might be US dollars, right? And then what do you see? What are the direct costs? In which currency are you incurring direct costs? That is also what determines your functional currency. Direct cost means the salary or the wages that you pay, right? Not the operating expenses, but the cost of sales. From where, in which currency are you buying the raw material? So that is the currency of primary economic environment. Then the currency in which your competitors work. Okay. So your competitors' forces are working in which currency, even that determines your functional currency. So once you have your functional currency with you, now you start applying the rules. But what if my selling price is quoted in US dollar, my direct costs are incurred in INR, and my competitors are both in US dollars and in INR? So this becomes ineffective, and these two are like 50-50. So how do I conclude what is my functional currency? Is there any way I can conclude? I go to secondary factors. So secondary factors is the currency in which I incur my indirect cost, the currency in which I raise finance, I get a loan. That's my functional currency, right? So this is what we mean by functional currency. Now, if the functional currency of the subsidiary is different from the functional currency of the parent, now what to do, guys? What to do? If this happens, you will say that all the results of the group will be first calculated in the functional currency of the subsidiary, whether it's goodwill. All the results of the subsidiary will be first taken into account in the functional currency of the subsidiary. So first you'll calculate goodwill in functional currency of subsidiary. You'll calculate net assets of the subsidiary in the functional currency of the subsidiary. Later on, you'll retranslate. What are the rules of retranslation? Later on, you retranslate all the assets and liabilities of the subsidiary are retranslated at closing rate. All the income and expenses, yes, all the income and expenses are retranslated at average rate, right? Average rate. So in this case, if I talk about a situation of net assets, I have my opening net assets. So my opening net assets will go at opening rate, which was the closing rate of the previous year. My closing net assets will be retranslated at the closing rate. But the profit or loss which was made during the year, that is the movement in the net assets. Your earnings during the year increase or decrease your net assets. So that profit or loss will be retranslated at average rate. And that's the reason you get always a balancing figure, which is known as retranslation reserve. From where do you take this retranslation reserve? From where do you take this retranslation reserve? Come on, quick. It goes via other comprehensive income. Is it ever reclassified to P&L? Yes. When I dispose my subsidiary, this gain or loss on retranslation will be reclassified from OCI to P&L. You don't know about reclassification? Visit the current issue section on my YouTube channel. You'll find the video on technical article of reclassification. Okay. So reclassification happens. And if there is a retranslation reserve, on goodwill of the subsidiary, will this have a share in NCI? Like, will NCI have a share in this? NCI will only have a share in retranslation reserve on goodwill if it was full goodwill. If it was proportionate goodwill, yes. If it was proportionate goodwill, NCI has no share. We leave NCI, okay? You are not taken into account. You go to hell. We don't need you. So we don't take NCI share into account in goodwill impairment. Then we don't take NCI share of goodwill. We don't take NCI share of retranslation reserve as well, because we didn't include NCI at fair value. So this is the rule for group foreign currency. Let's now talk about group statement of cash flow. There are some few special adjustments in group statement of cash flow. Let's have a verbal discussion first of all. So in cash flow, we prepare the cash flow statement by indirect method, right? We have our cash generated from operating activities, then we have our cash generated from investing activities, then we have cash generated from financing activities. And in that case, you start with PBT for operating activities, then you adjust for non-cash expenses like depreciation, amortization. You adjust for non-operating expenses, like which should go into investing but are there in the PBT also. So you adjust them, like gain or loss on disposal of a property that goes into investing activity. So you remove it from the operations, or you remove it from the operating activity. Then you have your working capital movement. If the current assets of a company increase from previous year to current year, we say you've purchased the asset, so it's a cash outflow. If the current assets decrease, we say we've sold the assets. That's why it's a cash inflow, right? And then if I talk about further, what about current liabilities? If my trade payables decrease, that means I've paid them money. So that's a cash outflow. If they increase, that means I've held their money. I've held their money. So that's a cash inflow. Then you have investing activities, any proceeds from sale of PP, any amount that you've paid as purchase of PP, that is an outflow. Any dividend that you've received, that's an investing activity. Any dividend that you pay, that's financing because you're paying it to the shareholders. That's how you raise finance. If you have repaid any loan, that's financing. If you have issued share capital, that is financing, right? So this is the bifurcation of operating activity, investing activity, and financing activity. Now, in group statement of cash flow, what is different? What is different in group statement of cash flow? Let's consider that. When we buy a subsidiary or when we dispose a subsidiary, this goes into investing activity, okay? This goes into investing activity. Because if you buy it, it's a cash outflow, which should be recorded in. When you buy it, it is a cash outflow in investing activity. When you dispose it, it's a cash inflow in investing. So let's suppose you paid $1,000 to buy a subsidiary. So you must record it at net amount. What is the net amount? If you bought a subsidiary, that also brought some money with it. You bought a subsidiary, you paid 1,000. You can't be so ungrateful. The subsidiary is also bringing a box of treasury, its own bank account. So what is your net cash outflow when you purchased it? You'll calculate that net cash outflow and that would be recorded in investing activity. Similarly, in case of disposal of a subsidiary, you will say, I received something. Okay, I received cash by selling a subsidiary, but along with it went the box of treasury. So what's your net cash inflow? Calculate that and show that in investing activity. Then later on, what are further adjustments? If I talk about working capital, please listen to it very carefully. What's our logic? We say, let's assume a situation where on the opening date, that is 1st January 2020, let's suppose 2023, okay? Our inventory, that's our current asset, was 10,000, okay? And at the reporting date, that is 31st December 2023, it was 15,000. And during the year, mid-year acquisition, you acquired a subsidiary whose inventory was 5,000, okay? And you disposed a subsidiary. This is the subsidiary acquired. Then you also disposed a subsidiary on the same day whose inventory was 2,000. How will you calculate the movement? How will you calculate the net cash flow through this inventory? When you purchase the subsidiary mid-year on 1st of July, its results are not there in the opening balance, but its results are there in the closing balance. You purchased it during the year now. When you dispose the subsidiary during the year, its results are there in the opening balance, but its results are not there in the closing balance. So can you compare this closing and opening? They are like for like. They're not like for like. So what we will do, we will adjust our opening balance because we are kind of harsh towards opening balance. We say, okay, we'll adjust you. So let's adjust our opening. These results were there in the opening balance, but not there in the closing. So let's remove 5,000 from opening balance. This subsidiary disposed is not there in closing, but there is. Okay, this will be added. Why? Again, you acquired a subsidiary during the year. Its results are there in the closing, but its results are not there in the opening. So I add the results of 5,000. Then I disposed a subsidiary during the year. its results are not there in the closing because you disposed it, but they are there in the closing, so remove it. So what's your adjusted opening balance? 10 plus 3, 13,000. Right? 13,000 is the result. Now compare it. Now compare it with the closing of 15. So you get an actual cash flow of, my inventory has increased from 13 to 15. You get an actual cash outflow of 2,000 because the inventory has increased. So this is how you adjust your opening balance for all the working capital movements, whether current asset, whether current liability. You apply this logic that in case of step acquisition during the year, we add it in the opening balance. In case of step disposal during the year, we deduct it from the opening balance and we get our adjusted opening balance and we compare it to the actual closing balance, and that gives us the movement. Right? So that's it for our working capital. Lastly, there are some adjustments which you need to make. For example, dividends. How much dividend have you paid to associate? Or have you received from the associate, which goes into investing activity? So you'll make a T-shaped account of the associate. How much dividend have you paid to NCI? For that, you'll make a T-shaped account. Dividend paid by the parent to the subsidiary or intra-group. Okay. Dividend paid by the parent to the by the subsidiary to the NCI is not intra-group. But the dividend paid by the subsidiary to the parent is intra-group, so we don't record it. So what was the dividend paid to NCI and what was the dividend received from associate? We make a T-shaped account for it and we get a balancing figure. That balancing figure is basically our cash flow. And anyway, we are not expecting a question on cash flow. So if you know this much from cash flow, it's more than sufficient. So you understand that this is how I have to calculate cash flows. If there's a property, plant and equipment, you make a T-shaped account of it, brought down amount, depreciation, disposal. So you get a balancing figure that how much did you purchase during the year. So you need to find the actual cash flow for all the line items so that you can account for it in the statement of cash flow. Right? So this is what we have in our statement of cash flow. Now we are done with our group accounts. We've done the basic groups, balance sheet, P&L, associate accounting, and we've also done our group change in group structure. Plus, we've also done our foreign exchange and group statement of cash flow. We've revised it completely. Okay. So I hope you all understand this. I hope you all understand this. Now let us move on to our next topic, that is share-based payment, IFRS 2. See, the share-based payment talks about that there are two kinds of share-based payment. One is equity settled share-based payment. Another is cash settled share-based payment. So in the equity settled share-based payment, your entry is expense debit, equity credit. That is when you're giving shares or share options to your employees. That is equity settled share-based payment. Cash settled share-based payment, what is my journal entry? Expense debit, liability, credit. Because I will make a payment of cash in future. Yes, I'll make a payment of cash in future to my employees. So I create a liability out of it. So what's my treatment? In both these situations, for equity settled, you need to figure out what are the vesting conditions. On what conditions are you giving these share options to your employees? There must be some vesting conditions. So these vesting conditions are divided between market conditions and non-market conditions. So market conditions are something which are not discounted because these are not in hands of the employees. If you say inflation will increase, then we'll give you share options. How can employee control this? How can you estimate the number of employees on the basis of it? That how many of them will meet the vesting conditions? So this is already taken into account in the fair value of the share option at grant date. But when we talk about non-market, that means performance related conditions. They are discounted while calculating the number of employees who will get the share options. They are discounted while calculating the number of employees who will get share options. So you take, see, in the case study, they will tell you that, the vesting period is 3 years. So maybe the vesting condition is if the employee stays with us till 3 years, only then they will get the share options. So in the first year, you will see how many people actually left the company and how many are estimated to leave in the next 2 years. Same for second year, you will see actual people who've left and what is the estimate to leave in the third year. You always take your estimate at the year end. You never take your estimate at the opening date. Please mind that. In the case studies, you will be tricked into a situation where they like the estimate is at the opening date. You don't take the opening date estimate. You take it at the reporting date, right? Then in year 3, there won't be further estimate. So you will just take actual amount. Yes. So this will give you your year 1, year 2, year 3's estimate of number of employees who will get the share options. Now you're supposed to know the formula. In equity settled share-based payment, your formula is you record an expense and you record equity. Yes, you record an expense and you record equity. So your formula is fair value of share option granted into number of employees who are going to get this. Yes, this is at the grant date. The grant date is taken into account in equity settled share-based payment. Then into the vesting period, if it is first year out of the 3 years, you'll prorate it. So number of employees, fair value of share option, number of share options which are given to them, you'll prorate it. In cash settled, the formula is exactly same. Number of employees into number of share options, SARs. Fair value is taken at each reporting date. That's the only difference. Rest everything is same. Fair value is taken at each reporting date, not just the grant date. So that's what you do in IFRS 2. Then for cash settled share-based payment, what you should always remember is that when we settle the liability of cash settled share-based payment, it's always whenever you exercise, yes, whenever you exercise the SARs, they are always given back or the money is given back to the employees at intrinsic value. So you have your opening liability, cash is paid at intrinsic value, your closing value of the liability is calculated as per the fair value at the reporting date. This gives rise to a balancing figure. I was explaining this to all my students yesterday in the doubt session as well. So that balancing figure goes via P&L. That's it. So if you know this much from IFRS 2, I think this is the major part which we should be revising. There are more folds to it, which is okay if, right, at this point, it's fine. If we know this basic, it's enough. Then IS 19 employee benefits. For employee benefits, just know that there are two jars. One is the jar of pension obligation. Another is the jar of planned asset. Yes, defined benefit pension plan. I'm talking about not defined contribution. So in pension obligation, you take this initially at present value. You record it at, the pension obligation is recorded at, just a minute. Who told you to export this? Okay, just give it a minute. Okay, so IS 19, I have a planned asset, I have a pension obligation. Pension obligation is recorded at present value. Planned asset is recorded at fair value. That's the rule. So the difference between this, Whenever I have, whenever, yes, whenever I have planned obligation is greater, pension obligation is greater than the asset, I have a deficit situation, net deficit. If the asset is greater than the obligation, I have surplus situation. So just from IS 19, what we all should be knowing is this formula that if I start from the deficit, opening deficit, what happens? You get an actuary figure at the end of the year. Yes, actuary gives you the figure, figure, actuarial sciences. You all know this. So you get a figure from actuary who says what is the net deficit for this company. So you have contributions. Contributions made into the planned asset. They reduce your deficit. Why? Because they increase your asset. Contributions are made into the asset that increases the asset and therefore it decreases the deficit. So you are sad. If someone increases the asset, you'll become less sad, no? So sadness decreases. Deficit is a sad situation. Then you have net interest, which is added. Interest is given to you in the question. Benefits paid out have nil effect. Inert gas, no impact. Then you have your service cost. Service cost is increase in obligation, can be current service cost or past service cost, which is added. And then you have your difference, what closing you were getting versus what closing the actuary is getting. This gives you the remeasurement component. So out of this remeasurement component goes via other comprehensive income, and this goes via statement of profit and loss. This also goes via statement of profit and loss. This is a cash flow. So the only thing which is a cash flow in IS 19 is contribution. So this goes into operating activities. Yes. So this goes in P&L, these two things. Remeasurement component goes to OCI. Is it ever reclassified to P&L? It is never reclassified to P&L. This remeasurement component is never reclassified, right? And then we also have a concept of asset ceiling, which is also part of remeasurement component. That means once you have a surplus, maybe the surplus was of $100 million. You said my planned asset was greater than the pension obligation. Prudence. You can't put bad, evil eye to your asset situation. You're saying I am having more assets than my obligation. That's a good thing, but you can't be, very over optimistic. So you need to caution against over optimism. So you say record your surplus at lower of two amounts. What are these lower of two amounts? The amount at which you've already recorded it, which is 100 million. And what would be the actual benefit you will receive from that surplus? So actual return that you will get in form of refunds from the pension plan or in the form of reduced contribution in the future. So in future, your contribution will reduce. In future, your contribution is going to reduce. Why? In future, your contribution is going to reduce. If you have a surplus situation, why would you contribute further? You already have enough funds available with you to deal with your pension obligation. So you will not contribute further to your planned asset. So you take your asset at lower of these two amounts and you seal your asset. You cap your asset. So let's suppose the ceiling amount is 50 million. So you've recorded it at 100, but you should take it down to 50. And that loss goes via OCI remeasurement component. So even that becomes part of remeasurement component, right? So this is what we have for IS 19 remeasurement component. And lastly, we have amendment, settlement, curtailment. So amendment, settlement, curtailment, what do we talk about here? Amendment happens if you amend your plan. You said I will give the pension to 100 employees. Now you have a mood swing and you say, no, I'll give it to 200 employees. So you're making amendments to your previous plan. That is increase in pension obligation because of past reasons. So that is past service cost, right? Settlement can be, yes, settlement can be like when you're making your employee redundant. So you can make him redundant with settlement or without settlement. If you lay off any person due to your own operational reasons, you must pay them, right? You must compensate them. So that extra pension that you might pay to people who you have made redundant, so that is settlement. That profit or loss arises on settlement, because once the employee goes, his obligation is settled and amount is paid to him. So if you have paid him less amount as opposed to his liability, then you made a gain. That was a good deal. So that gain or loss also goes via P&L as part of amendment settlement. Same with curtailment. Curtailment is also redundancy with settlement or without settlement. So here redundancy comes into picture. So in IS 37, you are given the rules when you record redundancy provision. Earlier of two dates, when actually the redundancy happens and the date it was formally planned and announced, and the affected parties had valid expectation that there will be a redundancy. So you create a redundancy provision, and you always create a provision on redundancy cost. You do not create a provision on restructuring or, relocation, because that's an ongoing activity. So your IS 37 also got revised with this. So basically, we have planned amendment, settlement, curtailment. All the gains and losses goes via P&L for planned amendment, settlement, curtailment. And let's not forget that in the recent changes of 2019, they say whenever PASC happens, you're supposed to update two things: your interest rate of calculation of net interest in the previous formula, and your assumptions to calculate service cost in the previous formula. So on the date of PASC, you guys are supposed to, you guys are supposed to update your assumptions and interest rate. Correct? So this is about IS 19. So the major portion of SBR, which had 15, IFRS 15, revenue, NCA, your IFRS 9, leases, your group accounts, IFRS 2 and IS 19, we've revised. We have more standards, like we have small standards of events after reporting period, adjusting, non-adjusting. We have deferred taxation. So deferred taxation, if I just give you a brief, it's just that in SBR, you should be at this point, okay? If anyone refers to this video after the paper, like presuming that I'll prepare via this video only, it's not possible, because it's very much in depth. I'm just revising the concepts, like I'm brushing up the concepts in fast track manner. So in deferred taxation, you have to record whenever your carrying amount of an asset is greater than the tax base. So you say, I will pay less tax today, tomorrow I'll have to pay more tax. So this is a deferred tax liability. If my carrying amount is lesser than the tax base, today I'm paying more tax, tomorrow I'll have to pay less tax. Deferred tax asset, right? So you create a deferred tax asset or a deferred tax liability via statement of profit and loss always. But if the related item due to which the DTA or a DTL arises is kept in OCI, so apply matching concept and say even the DT and the DTL will be created via OCI. Then very important concept which is mostly asked is unused tax losses. Yes? So these unused tax losses are carried forward to future years to get tax deduction, to get a DTA. So that's why you create a deferred tax asset on them, because in future you will get a tax deduction if you will make a profit in future. So only one condition when you can create a DTA on these unused tax losses, if you have solid evidence. If you have solid evidence that there will be future profits, then only you create a DTA for unused tax losses. Then what else is there? Forget about IFRS 2 and IS 12. That is a complex thing. Won't be tested. Let's talk about the IFRS 3 and IS 12. Business combination and IS 12. Deferred tax. How are they connected? Yes. How are they connected? How are they connected? So in business combination, you take all the assets of the subsidiary at fair value, but as per the standard, they're still at the carrying amount, no? As per the individual accounts, they're still at the carrying amount. As per the taxation authorities, they're still at the carrying amount. When you take them to their fair value, this gives rise to a temporary difference. Taxation authorities' tax base is different. What fair value you've recorded is different. This gives rise to temporary difference, which further gives rise to a DTA or a DTL, which is also recorded on the date of acquisition in working note number 2 of consolidation. That is what is happening with deferred tax with business combination. Then if I talk about further standards, small standards, IS 12 done, IS 10, IS 37 partially we've discussed. When a provision is created, it's recorded via P&L debit, provision credit. And if it is probable, then only a provision is created. Otherwise, you just disclose a contingent liability. So contingent liabilities are just disclosed, whereas provisions are actually recorded. If you get any question where they talk about insurance claims, so insurance claims are contingent asset. You act prudent. You need to get into the probability. What is the probability that your insurance claim will be approved? So if you think it is 95% above, the probability is 95% above, then you say it's virtually certain and you record an asset. Otherwise, if it is just probable, okay, if it is just probable, then you just disclose a contingent asset. That's an application of prudence. If someone asks you where prudence is applied, IS 37 is the best example. When the outcome is probable, you record a provision. But in case of asset, when the outcome is probable, you just disclose a contingent asset. Double standards, no hypocrisy. So that is prudence. Then you have your operating segments, IFRS 8. You have some rules for it. See, operating segments are to be separately disclosed if the chief operating decision maker, CODM, is using those results and those results are separately available also. So if the CODM is using that result, chief operating decision maker for that particular segment, whenever he's making decisions, he's using those results and those are separately available. And following rules, any of these conditions apply, then we say it's a separate operating segment. What are these rules? 10% revenue rule. So the revenue, both external or internal revenue, if it is total 10% of our revenue, condition is met. Record it as operating segment. Then PBT, talk about profit, 10% of the profit. So basically, you take profit or loss. So you total segments which are profit making. So let's suppose there are 5 segments, 3 are profit making, 2 are loss making. So you'll total the profit of those 3 segments, total the loss of those 2 segments. Whichever is the higher amount, you keep that as threshold. And then you compare each segment. Is it 10% of that higher amount? Is it 10% of that higher amount? If yes, operating segment. Then 10% of total assets. So let's suppose out of 7 segments, you said I identified 3 segments as operating segment. But if I take the external revenue of these 3 segments, and that is not 75%, at least 75% of my total external revenue, then I say add 1 more segment or add 2 more segments to meet the 75% criteria. So these are the conditions which we've discussed already. If you're an enrolled student, there's a proper lecture on IFRS 8 operating segment. So these are the conditions. Revise it through your crash course notes. Okay. Then difference between joint venture and joint operation. Joint operation is if we together start an operation, I say I'll teach you, edit videos for me, you give me the platform, that's a joint operation. We didn't create a company, which is a separate legal entity. You share income and expenses with me. I put in assets and liabilities. So whatever income belongs to you, we'll record it. Whatever income or expense belongs to me, I'll record it. That's it. That's what you do for joint operation. Whereas what is joint venture? Where 2 people come together. First of all, you have a joint control there, where 2 people come together and they open a new separate legal entity and there is unanimous voting. What is unanimous voting? When everyone will agree to the decision, then only we will go ahead with that decision. That is unanimous voting. So if these two features are there, then it's a joint venture. How do you deal with a joint venture? It is dealt under IS 28, equity method of accounting, just like an associate. So cost of investment in joint venture, share of profit in joint venture, post acquisition. So this is how you treat your joint venture and your joint operation. Right? Okay. Now, I think majority of the standards we've discussed. IFRS 13 is also there, where we talk about the definition of fair value, where we talk about level 1, level 2, level 3. Level 1 is prioritized, where we talk about identical assets and their quoted prices in the active market. Level 2, we talk about, okay, similar assets, maybe in active markets, or identical assets in less active market. In level 3, we predict. So level 1 is prioritized. And then how do you determine the active market? You need to take principal market. If you are able to find what is principal market, the market in which highest number of transactions happen. Principal market, voluminous transactions. If principal market is not available, then you go for most advantageous market. Okay. This most advantageous market is determined by looking at transaction cost and transport cost both. So most advantageous market is where the net realized value will be maximized, where you consider transaction cost and transport cost both. But when you get this most advantageous market and then you value the fair value out of it, then you don't take into account the transaction cost, because transaction cost is the feature of the market and not the feature of the asset or the liability. We've done TYUs on that. We've done questions on that. My students at TG Profs, you were given the mock one and this concept was there. Right? So this is what you have to understand from IFRS 13. And then I think you have standards on SME. There are some exemptions given to SMEs as opposed to IFRS. Just go through that through your crash course. Then you have your analysis part. You have EPS. So EPS calculation won't be tested in SBR, so don't worry on that. They'll just ask you about advantages or disadvantages of EPS as a ratio in your analysis. Question number 4. And then you have your current issues. So current issues already, I have a proper video on it for 45 minutes. Just go through that video and that's it. So if I have to explain you your strategy for the remaining 2 days, okay. If I have to give you your strategy for the remaining 2 days, I would say SBR pre-mock. Tomorrow on my YouTube channel itself, I'll be uploading a debrief on SBR pre-mock of March 2024. However, ACCA has already given this debrief. So if you like ACCA's debrief, if you understand that, you can attend it. But if you want my debrief, it will be available tomorrow on the channel. So you should solve this paper, attend its debrief. Second, you should revise the standards. We did them today. You can now further read the notes. If you have any notes that you've prepared while your studies, whatever notes you've prepared, your own notes. If you have followed some notes, those notes. Read the standards. No more practice, just the pre-mock. I hope you guys have done your Super 20. Now no more practice, just the pre-mock discussion, solving the pre-mock, that's it. And then, lastly, please listen to the Spotify podcast. If it is available for you in your country, don't miss on that. Some people are not able to access it because of some issues, like I think some students in Pakistan and Africa are not able to access it. I don't know how to resolve this, but the ones who could can enjoy the Spotify podcast also. And yeah, that's it. So I will be sharing few important voice notes on my WhatsApp group. So be part of them. That the number on which you have to WhatsApp to be part of them is this. Once again, I've written it on the board. And in future, if you want any class for SBR or advanced audit, let's do a little of marketing also. So you can visit www.tgprofs.com and you can get yourself enrolled if you're looking for SBR, FR or advanced audit. These are the only 3 subjects that I teach. So that's it, guys. I hope it was a helpful session. I, yes. Okay. I give you all of my best wishes. Okay. Keep smiling. Your smile really matters a lot to your parents, to yourself. These exams will go, they'll pass by. At the end of the day, your mental health, your stress level, your anxiety, you should not be getting into those things. You know, sometimes we get over with the qualification, but they give us multiple effects on our mental health. So I don't want my students at least to have such things. So don't be so stressed. It's just an exam. You'll pass this exam. No doubt, just manifest, be positive. I've told you multiple times. I've done the marathon on SBR where we solved questions. I told you the hacks to tackle case study. So there I told you that it's the cool mind which will help you pass. Professional level is all about common sense. Professional level is you got the technical knowledge. Today I taught you multiple standards, important standards, everything got brushed up. You know the knowledge. Now you have to apply this knowledge. You have to first identify in the case study what is being asked. Identify the standard, identify the area of the standard, state the standard. Stating the standard gives you a lot of marks as well. So don't lose those easy marks. Okay. And then you start applying that standard and you just conclude. So if a question is for 7 marks, you need to write 7 bullet points. How difficult is that? You can make multiple points just by stating the standard. Out of 7, I could get at least 4 marks by just stating the standard. Just be relevant. Don't, IFRS 9 is this huge. If a question is asked on hedging, stick to hedging. If the question is asked on loss allowance, stick to loss allowance. So you have to figure out which part of the standard is being tested. Then you mention that part of the standard and then you apply. So don't worries. I will be again, hopefully be coming live or having some last address with you one day before the paper. We'll just chit chat for another 10 to 15 minutes maximum. And we'll just have some last minute tips. But this is it from my side. So I'm officially signing off from my support for March 2024 for the SBR and the FR students. All the very best to you. It was really great to have you all with me in this whole quarter. May God bless you all. I've not seen you, I've not met you, but you guys were there throughout the session. So congratulations. You've gained some knowledge, you've gained some confidence. Lots of wishes, blessings, and love to all those who are watching this or will watch it thereafter. May God bless you all. May you all pass with flying colors. And once you pass, not before that, once you pass, do let me know if all these supports or all these things helped you or not. That really motivates the tutor also to keep on going. So, all the best. Sending you the best wishes, manifest the best results, the positive outcome. Keep your cool mind, stay hydrated, keep your health also fine, and you'll get through this. We got this. All the best. Bye.